Welcome to the third day of the Economics of Payments conference, the third and final day of the conference. And greetings here again from Helsinki, Bank of Finland. We are having today two sessions, and we start with a keynote presentation. So my name is Matti Helqvist, and I'll be doing the housekeeping from here and from Helsinki as in the previous days. Let me remind you of the housekeeping issues. So during the sessions, please keep your microphone muted and your camera off. And if you are given the floor, then you can open the camera and your microphone. We have reserved time, even a bit more than in the previous days, for discussions during the sessions. And also there is time for discussion after the keynote, in the keynote session. So feel free to use the chat for posting your question, or just noting that you would have a question that you would like to make. But let us move to the keynote presentation that will start today. Our keynote speaker is Dr. Dirk Niepelt. He's a professor of economics from the University of Bern and also the director of the study center Gertsensee. Dr. Niepelt is also the leader of the CEPR Research and Policy Network on FinTech and Digital Currencies. He has published a lot on the field of macroeconomics and recently also written a lot about CBDC, and his talk is basically going to combine these two aspects. That's what I understand. So please, I will give the floor to Professor Dirk Niepelt.
Thank you very much, Matti. I hope that you can hear me, and let me check whether I can move the slides. I think I can. Thank you very much for having me, and please let me know in case you cannot hear me or the slides didn't move. If I don't hear anything, then I understand that things are working. Thanks very much for having me, Matti. It's a pleasure to be in Helsinki today and to be with you today. I want to talk a bit about, as Matti said, the macroeconomic versus the political risks of CBDC. There's a lot of discussion apparently, and obviously, about what kind of risks retail CBDC would introduce into the economy. I want to talk a little bit about that, and my main message is going to be that maybe these are not that much macroeconomic risks that many of us have in mind here that we are concerned about, but more of political risks. So I will structure my 40 minutes or so that I have by spending a few minutes giving you a broader overview about risks that many associate with retail CBDC, focus a bit more on the macroeconomic risks, because this is what I've thought a bit more about. And then I will move from those macroeconomic risks to what I would call political risks and emphasize the presence of those. And the conclusion really will be something along the lines that the latter ones are maybe the ones that we should be most concerned about. What I will talk about today is based on work in the last couple of years, and including work with Markus Brunnermeier from Princeton. We co-authored one of the papers that I'm relying on today. And at the end of the slides, which I think you will have access to, there's a list of references where you can delve a little bit deeper if you're interested in. And all of these papers would also be downloadable from my website, which is listed here on the first slide. Okay, so let me start by thinking a little bit more about the broad overview of the risks that people associate with retail CBDC. And on a very high abstract level, on a helicopter tour, I would think that people are concerned along a couple of lines. Here I've listed a few. First of all, there's this idea that governments, once they get too much involved into retail payments, they might stifle innovation. In the current system, where we have a two-tiered system, the government or the central bank interacts with commercial banks, as all of you know, and we, the retail clients, we interact with commercial banks. And once we would have a retail CBDC circulating, there is potentially at least direct contact between the central bank and retail clients, more so than we have today, where we only interact through cash. And this direct connection might, in the medium term, lead to a broader, more important role of the central bank in delivering retail payment services. And since the government typically is not known to be the most innovative and the most productive service provider, there is a fear that this might stifle innovation in the medium to long run. A second line of argument that you often hear is that once the government or the central bank gets involved into retail payments, there's an obvious danger that the government or the central bank, monitors all these payments, as it would have to do to some extent in order to satisfy certain legal requirements when it comes to know your customer and tax evasion, etc., etc., and that this might be a severe danger. And if you have followed the discussion about the ECB's, the European Central Bank's projects on the digital euro, the ECB has asked European households, citizens, what they think about this. And one of the main concerns that the citizens raised was exactly that type of concern. So many citizens said, well, we like the idea, but we are really concerned about this, giving too much power, too much monitoring powers in the hand of the central bank. And we would like to see that power to some extent curtailed so that it doesn't become too big. So that's another strand of concerns that is present out there. Then there is an international dimension that I think many people have emphasized, which relates to the fact that if developed economies were to introduce CBDCs, this might endanger the monetary sovereignty of developing countries in the following sense. Basically, it's a story of dollarization, as we have known it for many decades. Dollarization means that in countries in which the monetary sovereign is not a very credible or a very reliable service provider, households might choose to switch, households and firms might choose to switch to other currencies, not the national currency, simply because the national currency is not trustworthy. And that is typically dubbed dollarization because this other currency typically is the dollar, or more recently also the euro in several countries. And that, of course, entails that the national monetary authority loses a lot of its power to influence economic conditions, the business cycle. It also means a loss of seigniorage for the national government, and it has other detrimental effects for national policy. And the fear now is that if, say, the US or the Eurozone were to issue a digital currency, which potentially would be accessible also to citizens in other countries, then these citizens might maybe be able to switch more cheaply to this alternative currency and thereby undermine monetary sovereignty in the destination countries. Again, this has potential macroeconomic implications, which are bad typically for the monetary sovereign in those countries. It might actually be good for the citizens in those countries because they might have suffered from financial repression, they might have suffered from a bad national currency. All of this might, in that respect, their situation might be improved, but the situation of the government or the local central bank might suffer from that. And depending on which stance you want to take here, this might be a good thing or a bad thing. This is sort of a third discussion that I think is out there when it comes to discussion about retail CBDC. And then finally, and that's what I really want to focus on today, there is this, I think, a very strong focus in the discussion about the macroeconomic risks that are, or that could be associated with the introduction of retail CBDC, which I would subsume under the heading of macroeconomic instability. And here the typical argument is that once the central banks starts to issue retail CBDC, a means of payment, which is, which the households and the firms in the economy can directly use, can directly access, then to the extent that this retail CBDC is adopted, it means that those households and firms typically would swap some of their deposits at the local commercial banks into retail CBDC, which means that the local commercial banks would lose part of their funding. To the extent that this happens very quickly, this might take the form of something like a run. And then there's the concerns that the commercial banks, by losing this funding, would have to also, of course, cut back on the asset side of their balance sheet, maybe extend fewer loans, There would be dangers of a credit crunch. This might undermine investment in the medium term and the long term growth. At the same time, to the extent that the central bank were to get into this kind of business, there's also fears that the central bank might develop into a bank that extends loans itself, and that there is a danger of what many people would call state banking. So is it that in the future it is going to be the central bank in the country rather than the commercial banks, which are in the business of extending loans, allocating credit, and again, therefore, a danger that because central banks might be less efficient in doing and providing these kind of services, that growth might suffer from this in the medium term or in the long term. I think these are sort of the dominant macroeconomic fears that are out there. And I'd like to address a little bit these last two points in more detail in the next couple of minutes. Okay, so how should we think about these macroeconomic risks? I think a useful starting point, at least for me, is to think about that in a very, very stylized setting with three balance sheets, which you see on that slide. And then later on think about to what extent the very basic argument that I'm trying to make here can be generalized to a more realistic setting. So let me describe the world as I view it on that slide here. There's going to be three entities. There's the central bank on the left-hand side with its balance sheet. Then there is the commercial bank in the middle. And then there is the private sector on the right-hand side, the non-banks on the right-hand side. Sorry, I've clicked accidentally on the slide. I have obviously reduced the items on these balance sheets very strongly, very significantly. So I've only highlighted or itemized those items which are relevant for the argument. So you see here the central bank that has, and I'm realizing, I'm not sure whether you see what I see here, that there's some banks here. I don't know what where this comes from actually, so forget about this. So the central bank has on its liability side in red the reserves and in black the cash. These are both liabilities of the central bank that they have issued. We have in the middle balance sheet, the commercial banks, they hold as assets the reserves at the central bank, and then they have liabilities, which are the deposits that they owe to the non-banks. And the non-banks, in turn, they have two types of assets here, the deposits, which are claims vis-a-vis the commercial banks, and the cash, which is a claim vis-a-vis the central bank. So that's the status quo that we are starting from. Now, what is it that happens if we start to introduce retail CBDCs? And here I want to think really about the introduction of CBDC as a process in which I go to my local commercial bank and I tell the bank, you know, I would like to swap my deposits that I hold with you into CBDC that I would like to hold at the central bank. So what is going to happen in the first place is that because the commercial banks have these reserves at the central bank, and to the extent that they have excess reserves, which they all have these days, the commercial bank's balance sheet basically would shorten. On the one hand, they would lose some source of deposit funding. At the same time, they would have to, by transferring payments or making payments to the central bank, they would lose reserves. And essentially, the non-banks would swap deposits against CBDC. And at the central bank balance sheet, the liabilities, the reserve liabilities, would be exchanged into CBDC liabilities. So far, nothing exciting. At this point, nothing important really has happened to the asset side of the commercial bank, in the sense that whatever loans they have extended so far, nothing of that will have changed. Now, suppose that there's even more of that going on to happen, and we reach the point at which the commercial banks have depleted their reserves at the central bank. Suppose that the non-banks still want to transfer or convert more of their deposits into CBDC. For the non-banks, essentially what we've seen on the previous slide will continue, even fewer deposits that they hold now, the same amount of cash, even more of CBDC that they would like to hold. For the central bank, more CBDC liabilities. The reserves now have been depleted, And for the commercial bank, the deposit liabilities are further reduced. And this is basically the situation that many people have in mind when they're concerned about the loss of funding for the commercial bank. Because if you forget about this red line at the bottom here, let's abstract from that for a second, then what you see that at this point we have a shortfall essentially of deposit funding, which would have to go along or go hand in hand with some other reduction of assets in the commercial bank's balance sheet. But, and the point here, the important point is, to the extent that the central bank has issued additional liabilities, it has issued additional CBDC to households or firms, these additional liabilities have to be invested somewhere. The question is now, really, what is the central bank going to do with this additional source of funding, the green plus here, the second plus, and it comes through the CBDC channel. By accounting necessity, the central bank has to hold some assets that correspond to these additional CBDC liabilities, and the question is, what are those assets? Now, if you think very mechanically in a very sort of short-term perspective, then you would conclude, well, those additional assets, they will have to be some loan or some credit that the central bank extends to the commercial banks. Why is this? Well, to the extent that I have asked my local banker to transfer some deposits into central bank digital currency, central bank liabilities, and to the extent that this payment has taken place and the central bank has actually accepted this incoming payment, by the very act of accepting it, the central bank has extended a loan to the commercial bank, unless it held some reserve relationship before which has been depleted. But this is what we have assumed now is sort of at the limit. The bank is in a corner in that respect. So by accepting the incoming payment, the central bank will have to extend some loan, some claim to the commercial bank. And that's what I've indicated here in red. So at least mechanically, at the very instant when this thing is happening, when this payment is actually coming in at the central bank, there's no hole in the balance sheet either of the central bank nor of the commercial bank by accounting necessity. And the only difference now is if you look at the balance sheet of the commercial bank, they haven't lost any additional reserves now because they didn't have any reserves anymore that could be lost. But instead, they have now acquired a new liability, which is a liability vis-a-vis the central bank, the national central bank. So they have exchanged deposit liabilities against central bank liabilities. Now, if you take that seriously, that very elementary or basic argument, then what you would conclude from this is that, on the one hand, the bank assets haven't changed. If you go, let me go back on the previous slide. Nothing really has happened here on the asset side of the commercial bank's balance sheet, except that they have lost reserves. So to the extent that this is the full story, what I told you on the previous slide, there's no need for these banks to change their loan policy, to extend fewer mortgages, to extend less credit than they used to do in the world without CBDC. The bank assets are unchanged except for the reserves positions of the commercial banks. There's no need necessarily at this point that credit or investment would be affected negatively. And if you look at the liability side of the commercial bank, then you see that the deposits, as I emphasized before, net of reserves, are simply replaced by a central bank loan at this point. And if you think about the state banking criticism that I alluded to at the beginning, what you also see is that here, it's not that the central bank would refinance Main Street or would finance Main Street. The central bank does not extend any credit to non-banks, to firms or households. The central bank simply extends credit to commercial banks. So the central bank refinances Wall Street, but it doesn't finance Main Street. So in that sense, the state banking criticism does not fully apply in that context. So this is a very, very Mickey Mouse argument, of course. There's no dynamics here. I haven't talked about prices. I haven't talked about anything really, just giving you a very, very basic balance sheet accounting framework to frame this. But it turns out that if you write down more sophisticated model in which you really take care of dynamics, in which you take care of general equilibrium effects, then it's not difficult. It's actually very easy to write down very general models, give a very general abstract argument in which the same logic applies. So if you write down fully specified dynamic models, you see that unless you want to impose additional frictions, it would very easily be still the case that the central bank can, by doing what I suggested on the previous slide, can insulate banks and the broader macroeconomy from the effects of retail CBDC. So this very basic argument really gives you the main thrust of the argument, which of course you have to then look at more carefully in its details, but the main thrust of the argument is that by issuing CBDC, the central bank gains a source of funding, and this additional funding, the central bank can in principle directly rechannel into the banking sector and therefore undo what the commercial banks are losing in funding by losing deposit funding. Now, of course, the argument is subject to several caveats. Let me emphasize a few, and maybe we can discuss a bit more later. So this macroeconomic neutrality of retail CBDC, which I just suggested, requires a couple of assumptions, and some of them are not realistic. So some of these assumptions would realistically not be satisfied. Let me emphasize 2 or 3 of those. One argument is, or one assumption, or one feature that you need for that is that if you look at it from the households or the firm side, CBDC and deposits, they need to generate the same, what I call here, liquidity benefits per resource cost of managing deposits and CBDC. Let me explain what I have in mind here. I mean, one scenario in which this would obviously not be macroeconomically neutral is, to make it very stark, is if you can pay your rent with deposits, but you cannot pay your rent with CBDC. Suppose that for some reason you can purchase certain things with CBDC, with deposits, but you cannot purchase them with CBDC for whatever reason. And then, of course, any substitution of the two, at least once it's big enough, would not generate macroeconomic neutrality, because there's some point at which households and firms are no longer able to conduct the terms of payments that they used to in the previous arrangement, and therefore neutrality would be undermined. That's what I mean with the liquidity benefits of these two types of means of payment no longer being satisfied. A similar non-neutrality would arise, and that's the second point here. Oops. When the resource costs are different. So it might well be that, paying your rent with deposits costs the central bank a certain amount of resources, because, they have to, they have to hire somebody that actually takes care of the payment, or they have to buy a computer system, or whatever the resources are that you need to make a deposit payment. And maybe the central bank, in order to make the same type of payment, would need a bigger computer or 2 people to do the same thing. So then the central bank, to conduct CBDC-based payments, would require more resources than the commercial bank. And if this were true, obviously, the neutrality would no longer hold. So that's one very important assumption that one needs to make in order to generate this neutrality result. So if the view is that central banks are issuing a means of payment, CBDC, or would be issuing a means of payment, CBDC, which for some reason is more costly to transact with, requires more resources to transact with, then macroeconomic neutrality would necessarily be undermined in that case. Another reason for macroeconomic non-neutrality would relate to let me go to the third one here, actually. It would relate to what is happening on the commercial bank's balance sheet. What some people would argue is that if you have a commercial bank that issues deposits, then, and at the same time extends loans to the real economy, then it is very important for the commercial bank that it has both the deposit exposure and the asset exposure, maybe to the same client, because there might be some information externalities that are generated by having the clients have deposits at the bank, or there might be some other synergies because between the liabilities and the assets that the commercial bank has. Now, if that is true, then you might argue, well, then the substitutability that I emphasized on the previous slide, namely that you can essentially replace deposit funding here with central bank funding over here, would no longer be guaranteed. Because if the commercial bank wants to continue doing its asset business as before, maybe it was only possible to do this if they had sufficient deposits, or maybe the deposits with the same client. But if these deposits are gone and now there's a central bank loan instead, then this is potentially no longer possible. So the substitutability of deposits and loans as a source of funding must be present, otherwise this is not going to work. Otherwise you will not be able to generate macroeconomic neutrality. And there's many sort of sub-stories why this substitutability may not be given to the fullest extent. Let me just mention two here. The first one relies or concerns collateral, right? I mean, typically central banks would only lend to commercial banks subject to collateral. That's at least what we observe typically in the real world. In the scenario, let me again go back here, that I'm describing, that would require that for this new central bank loan that we have introduced here, the central bank requires some collateral from the commercial bank. Okay, but in the previous scenario where the commercial bank had only issued deposits, there was no collateral necessary to get deposit funding from non-banks. So to the extent that the central bank would require collateral from the commercial bank, while the households did not require collateral from the commercial bank, there's another source of macroeconomic non-neutrality because it would undermine this type of substitutability. Now, if you think about this, this really gives rise to a broader and interesting discussion, right? I mean, why is it that households are willing to lend to commercial banks without asking for collateral, even if they think in the back of their minds at least that the central bank is standing behind the commercial bank to provide lend of last resort assistance if needed? But then if the central bank were to directly extend funding to the commercial banks, then there would be a need for collateral. So there's an asymmetric treatment in the current environment, and this neutrality result really highlights that. Now, another sub-story, and that's what I put here in red, for why the substitutability of deposits and loans may not be satisfied in reality if such a scenario were to materialize, is of course that the cost of funding for the central bank loan and for deposits may be different. And that's really the thing that I want to focus on now, because this is, I think, where really the political story and the political risks come to the fore. So let me focus now on this last channel. So the question now is, if you think again about this balance sheet scenario, let's abstract from all the other potential sources of non-neutrality. Let's say, okay, if the central bank is actually willing and able to refinance commercial banks, as I described it on the balance sheets, then we would have neutrality. We would have macroeconomic neutrality. But now is the question really, okay, what is the conditions? What are the conditions that the central bank will charge? What is the interest rate that the central bank will charge for those commercial bank loans? And in particular, will the central bank charge what I call here the equivalent loan rate? Let me introduce this concept of the equivalent loan rate. The equivalent loan rate is the interest rate that the central bank would have to charge on its loan to commercial banks after the introduction of CBDC in order to exactly replicate the financing costs that commercial banks had pre-introduction of CBDC. And this single equation here, which is the only equation in the talk, in addition to that one, it gives you the expression for this equivalent loan rate. Let me go through that very briefly and to indicate where this comes from, what it means. So what it basically says is that the financing conditions in the world with CBDC and this equivalent loan from the central bank should be the same as the financing conditions that a commercial bank had before the introduction of central bank digital currency. Let me start on the right-hand side. What is it? What is the cost for a commercial bank of funding real project, a loan, capital, say, by issuing 1 unit of deposits? Well, for the 1 unit of deposit, it has to pay the interest rate on deposits. I call this Rn. It will also have some resource costs of managing the payments which are associated with deposits. And the share of the deposits, which I call zeta, it will have to, or it will choose to invest in reserves at the central bank in order to enable to conduct all these payments. So of the $1 of deposits, it will have left 1 minus zeta dollars that can be invested in real projects. And on the right-hand side, you therefore get the net costs of being able to extend a loan of 1 minus zeta to firms, say. That's what it costs the commercial bank in the present environment. And therefore, on the left-hand side, you see how much it would cost the commercial bank to do the same thing in the new world where it gets a loan from the central bank. There it would only have to borrow 1 minus zeta units from the central bank because it doesn't have to hold reserves against its loan. And those would cost the equivalent loan rate RL. So if these two things should be the same, this equation gives you what the equivalent loan rate RL would have to be. And you can, of course, easily solve that. And you can compute this. All you need to know is what is the Rn, what is the reserves rate, what is the reserves to deposit ratio theta, and what is this cost of managing a unit of deposits. Now, if you do this, if you compute this equivalent loan rate RL, you can in the next step then make a back of the envelope calculation of how much funding cost, what I call funding cost reduction at risk there is for commercial banks. And what I mean by this is really how much is there of funding costs that could change if we would have a complete switch from deposits into CBDC. So if all the funding that banks gain by issuing deposits, net of how much of that they hold at the in reserves, that's the numerator here, N for deposits times 1 minus zeta, if all of this were to be swapped into CBDC, and if the central bank were to refinance banks not at the equivalent loan rate that I just told you how to compute, but instead at the risk-free interest rate, let's say this is the benchmark interest rate, then the difference between these two things really is how much the funding cost for the real projects that banks are funding could increase potentially if the central bank is not ready to refund the banks at RL, the equivalent loan rate,
of course,
but at the risk-free.
This was a totally.
So the question really is, how big is that number? And I report this number as a share of GDP, and I do this for the United States. And here, I'm running behind in time, so let me skip the first two slides, which just show you the kind of data I'm using. I'm using data from 1999 until today. These are the interest rates in the US that I'm using, but let me skip that. This is the time series for what I call zeta, which is the share of the ratio of reserves to deposits, which went around the financial crisis from basically 0 to something like 30, 40%, depending how you measure it. These are two different ways of measuring it. And let me go to the time series that I really want to show to you, which are the more important ones. This here is the funding cost reduction as a share of GDP that comes out of the calculation I just showed you. Again, running from late 1999 to the current date. And this is as a share of GDP, and I'm not sure whether you can see it better than I can. I can barely read the axis, but let me tell you that something like this is about 0.5% of GDP plus, and this is about 0.5% of GDP negative. So you see, first of all, that this funding cost reduction or this funding cost at risk for the commercial banks has significantly varied over the years. It has reached substantial magnitudes of nearly 1% of GDP just before the financial crisis, but it's also been negative at times. Why could it be negative at some times? Well, in those periods here, so after the financial crisis, there was extreme compression of interest rates in the United States, at least. So the deposit rate, the rate of the interest rate on reserves, and the risk-free interest rate, they were basically identical over several years, which means that by issuing deposits, the commercial banks did not really get any advantageous terms for their funding. To the contrary, in those periods, they would have run actually cheaper if they had just issued some risk-free bonds, because then they wouldn't have to deal with all of their deposit business, which generates some resource costs. Remember, there was this management cost of deposits. So in those periods, the banks would actually done better by just getting capital wholesale funding without having to run their retail businesses. But in periods in which the deposit rate is low relative to the risk-free rate, and also here, when the reserves to deposits ratio was still very low, the banks benefited on that from being able to issue cheap deposits rather having to borrow at the more expensive capital market rates. And this really tells you that in those periods, commercial banks benefited a lot from being able to run the deposit franchise. Now, in one of the papers where this is based on, I use different methods to compute this. And basically what I want to show you here is that if you do this differently, if you use more modeling assumptions, then you would actually find that this was never negative, but still very much significantly varying over the years and always in positive territory here. So the message is not really that this has always to be positive. Maybe it was negative at times. The message really is that this is very much fluctuating depending on the business cycle and the financing conditions in the economy. So the conclusion from this funding cost analysis is that banks would have time varying and at least at times very strong incentives to lobby the central banks. If CBDC were introduced, banks would very much depend on the conditions that central banks were willing to extend for the refinancing, if the central bank were willing to offer this refinancing. But at the same time, on the other side, so to speak, taxpayers would also have strong incentives to do so, because any cheap funding that the central bank would extend to commercial banks would mean lower seniorage revenues for the central bank, and therefore, more tax burden for the taxpayers. So the conflict of interest between taxpayers and commercial banks would become much stronger than it is today, and therefore there's a certain danger that banking and central banking could become more politicized. So that's a very long story now about the funding costs. Really, the punchline here is that many people argue that there is a big problem for commercial banks from retail CBDC because it would withdraw funding, undermine funding. The argument really so far has been, well, mechanically, you shouldn't think that there is a hole opening up in the balance sheet of the commercial banks, but what you really should think about and be concerned about, depending on which side you're standing, is that the terms and conditions for the funding might change a lot, and that this might put a lot of pressure on the central bank, because the central bank might be the one that has to provide the refinancing for commercial banks here. Let me mention a couple of other political risks that have been mentioned in the past, and which I think are all first order. This notion of what I often refer to CBDC or retail CBDC as reserves for all. I think that's, from a macroeconomic point of view, the defining feature of CBDC. And if you were to introduce such reserves for all, this could, of course, trigger many demands for more of the same type of broader access to the balance sheet of the central bank. Cecchetti and Schönholz, for example, they have already emphasized in 2018 that there might be demands for open market operations beyond the ones as we know them today, right? I mean, why is it that open market operations are mostly restricted to banks and not to other entities, right? You might, if you're a big company, you might argue, well, why shouldn't Main Street have access to the central bank balance sheet to the same extent as Wall Street has? Why are there these double standards? All of these could be part of the discussion once the first step of reserves for all is taken. This, of course, would mean that there's potentially new types of credit risks on the central bank's balance sheet. Then there's an argument that Paul Tucker made in 2017. Similarly, the broader universe of households, or at least firms, might ask for lend of last resort support when it comes to systemically important illiquid firms. We now have this discussion whenever a bank is in that situation, or more recently also when government's in that situation, but we typically do not yet have this discussion when Firms from the real sector are in that situation, but you might very well also get discussions about that one once you start to go down the road of reserves for all. Then, of course, there is discussion about longer central bank balance sheets. I'm working in a country, Switzerland, which is renowned, I think, for its institutional stability. But let me report from Switzerland that even here, once the central bank extended its balance sheet to a very, very large size, as you know, more than 1 GDP, there's now very much ingrained expectations in the political sector that the central bank will deliver year for year high and stable seigniorage revenues to the public sector, to the governments. And some parties actually are starting to ask for more. So even in a country like Switzerland, a long balance sheet essentially invites political pressure, and we see that happening even in a country like Switzerland. So I think there's a very robust expectation that having a longer central bank balance sheet will increase potential conflict between the different interest groups, which in that case would be the taxpayers on the one hand, who are interested in higher seigniorage, then creditors on the other hand, and central bank debtors. In the story I told before, the central bank debtors would be the commercial banks, which hope to get cheap refinancing, which would directly contradict the interest of taxpayers who want to have high seigniorage revenues. And then, of course, there is, again, depending on your views, the dangers or not of granting stronger powers to the monetary authority. One aspect here is cash, which I would expect to come under stronger political pressure in a world with CBDC, not only because some of the cash might directly be converted into CBDC by households, but maybe more importantly, that in response to these direct substitution effects, network effects would undermine the usefulness of cash eventually. Think of Sweden in that context. And to the extent that this would again weaken the usefulness of cash and thereby weaken the use case of cash, there would be weaker and weaker political interests that favor the maintenance of cash, and the political pressure which comes from the other side to abandon cash, or at least to make it less and less useful, would gain the upper hand eventually. So the notion that you can introduce CBDC without touching cash, I think is conceptually perfectly correct, but from a political point of view, I would expect there to be some interdependencies. Now you might say this is great, because you might say we should abolish cash anyway, since it would also help us abolish the effective lower bound on monetary policy, and that would allow us to do many things. And that's probably the view, certainly the view that many people have taken, in particular those that have a very positive assessment of what central banks could do and should do. And then some other people have a more skeptical view. They say, well, you know, limits to monetary policy and securing the privacy in payments through cash is a very valuable option, and anything that would weaken that is a danger to how we run our society. So there's, I think, a lot of political views and maybe even ideology in that debate, but certainly this is, I think, a first-order issue when you think about reserves for all. So as an introduction of retail CBDC, as one consequence, I would see a better perspective or more options for more muscular and conflictual monetary policies to follow in the medium to the long term. My time is up, so let me conclude, offer some concluding remarks. I think it's clear that retail CBDC would offer very, very wide-ranging economic possibilities, but also pose some economic risks. I think we have learned a lot in the last 3 to 5 years, both because of pilots that central banks have been starting to be engaged in, but also a lot of research that has come out in the last few years. And what we see these days, or what we, I think, start to see these days, is that the effects of retail CBDC would be very, very far-ranging. One consequence of this, I think, must be that the discussion, and in particular the decision about retail CBDC, has to be clearly taken out of the hands of central banks. Currently, the discussion is still very much in the realms of central banks, the BIS and the central banks, and maybe some international organizations. are debating about that, but parliaments and voters are still not debating a lot about this topic. But I think eventually the decision about retail CBDC will have to be taken by parliaments and by voters, because the consequences far extend beyond monetary policy and financial stability. There's much more to think about, and therefore this is not a decision for central banks to take. The macroeconomic risks, I think, appear manageable. At least they're not as large as many people, I think, have argued in the past. Let me advertise an ebook that CPR will issue in about 5 or 6 weeks, just about CBDC, which includes, I think, 19 chapters written by people who have done research on the topic in the last few years. And I think one of the themes that comes out of these chapters is indeed that the macroeconomic risks, they are there to some extent, but they're much less dangerous than I think we would have thought 3 or 4 years about. Because essentially the central bank has a huge role to play here. The central bank in principle can intervene along a couple of dimensions to cushion the effects for banks and therefore for the wider economy. But what I was trying to emphasize in this talk is really that while the macroeconomic risks appear manageable, at their source, they're really often political risks. And I think these risks are large, and who knows, how they will eventually play out. I emphasized one particular of these risks, which is the funding cost reduction at risk and what that would mean for banks and bank businesses. But I think there's much more in terms of politicization of central banks and all the implications this could have. So I think a very important dimension of the decision, yes or no, when it comes to retail CBDC, will really be concerned with the question, how able are society to manage the various conflicts of interest that are present in each society? But are we able to manage them in ways that will insulate banking and central banking from these conflicts? Or will these conflicts eventually spill over into the conduct of monetary policy and do so much more once we have introduced retail CBDC? If we fear the latter, then I think the introduction of retail CBDC could be a very risky step. If we are confident that societies will be able to manage the different conflicts of interest outside of central banking mostly, then I think from a macroeconomic point of view, retail CBDC is not as risky as endeavor as many of us have thought in the past. Thank you very much.
Thank you very much, Dirk, for the very thought-provoking talk. And I noticed that Morten already has camera on, which is fine because Morten, you had one question there. I think I could give the floor first for you. We also test your microphone.
Yeah, I am. Thank you. I actually had a different question. I think it was just at one point you were, let me ask these two questions. One, how does your model changes if there's a full substitution from cash to CBDC? And the other question is really around, banks are complaining that they're losing deposit funding, but what are these deposits funding? And I think it's mad if they are already funding, for example, mortgages. The duration mismatch is just wrong. So I don't think there would be a big loss of welfare if that were to happen.
Hi, Morten. Thanks for the question. So on the first part, the cash CBDC substitution, I haven't talked about at all, as you point out, except, let me see whether I still have control over those slides here. I think I still have, right? They still move. Where was this? So yeah, so I think there's a little bit here, if you look at the lower part of that slide, to the extent that the political pressure on cash might increase. If we get cash into CBDC substitution, we have fewer people using cash, then the network effects would actually accelerate that effect. The usefulness would decelerate even more, and the political support for cash would dwindle. But from a macroeconomic point of view, I think this is really a non-issue, right? I mean, should we be concerned about people using CBDC as a means of payment as opposed to using this piece of paper as a means of payment, both of which are liabilities of the central bank? Basically, no, because for the commercial banks, there's nothing really that happens as a consequence of that. And I think the main concerns from a macroeconomic point of view really are that this might, affect the balance sheets of commercial banks, and that cash CBDC substitution would not really be an issue for that. So that's why I think that part of the substitution is not much of a macroeconomic risk to start with anyway. And in terms of mortgages or other forms of commercial bank assets or projects, I mean, the argument, if you buy into it, is that whatever they are, really they would not be affected if the central banks intervened along the lines I suggested. Because the central bank intervention would simply neutralize whatever is happening on the liability side of the commercial bank balance sheet. It would not affect at all what is happening on the asset side of the commercial bank balance sheet, except for the reserves. But then again, I mean, all the things that we really care about is, what do commercial banks invest in the real sector, so to speak, and whether these are mortgages or loans or whatever, would not have been a first order effect for the story that I was trying to tell here.
Yeah. You can also take the control back, Dirk. I mean, it was actually here, so we were maybe seeing different slide than you in the previous.
Yes.
Yeah. But we have well time, so I mean, I'm sure that there are other comments as well. There was one comment by Pasi Mahi on the chat, cash as contingency. Do you want maybe to explain that a bit more?
Yes, Pasi here. Sorry, I think I lost the exit point when during the presentation when I was having that comment. But of course, just to highlight that it has other demand also. I mean, cash as a contingency for any digital solutions. That was only point, simple point there.
It's a contingency.
Yes, I think the contingency point is I'm not sure whether I understood correctly, but I think it's a very important argument in favor of cash, right? I mean, we want to, or I think it would be useful for societies to have a means of payment that would also still work if many things do not work anymore, right? I mean, I'm not sure whether this is what you have in mind when you say contingency instrument. If you read what central banks are worried about, or some of the central banks that are in the CBDC pilot stages, what they are worried about is, one, that they lose control to private institutions, that they lose sort of their direct influence on the monetary conditions in the country, and two, that related to this, they might actually not be able to, provide the payment services or the payment functionality in times of crisis, because who knows what the private sector is able to take precautions for those states. And then they argue, okay, that's why we should have a CBDC and a payment system based on CBDC, because that would allow us to still provide payment services even if the private sector goes under in some sense. But then, of course, I mean, many of the risks that the private sector is subject to would also affect a CBDC-based payment system. So if you think about war, or if you think about major natural catastrophes, or a big hacking aggression by state actors, etc., you might think that many of these risks might also, or that CBDC might also be exposed to many of these risks, and cash is something that would presumably still work in those contexts. So giving up cash is giving up a very useful option in that respect, for sure. Yes.
Yes, thank you. And like I said, any CBDC could be a honeypot for sort of a cyber risk or attacks.
Yes.
And there's a question by Esa Jokivuole here from Bank of Finland. So maybe Esa, you can speak out on your side. In the chat, but Esa, you can put on your microphone. As we don't hear Esa, so I can read that.
Yes, please.
Oh, you can see it, Dirk. Do you see the chat?
Now let me just open it, and yes.
You see.
Do you see alternative payment systems ultimately outside the central bank balance realm as a potential challenge that CBDC should or could and should address? Yeah, thank you, Esa. I think this is a question that, again, many people are struggling with, or at least the argument you often hear that now that we have DM or that we have Libra or whatever you call it, and now that we have many fintechs starting to offer cross-border payments, and that we have the credit cards trying to offer new cross-border payments, etc., it's high time for governments or to central banks to actually offer something which is competitive, because otherwise, we are losing control. And this comes, I guess, supercharged somehow, this argument, when you hear people in the US, which has been, I think, very hesitant so far to thinking about introducing a digital dollar, when they argue, now that the Chinese are doing it, the US should definitely also do it, because otherwise we lose control over a US-based international payment system. And I mean, conceptually, I think the argument makes a lot of sense to me, at least. I mean, there is a first mover advantage, we typically believe, in payments, in the sense that there's huge network effects. And once somebody starts to adopt a certain means of payment, then it becomes more interesting also for other parties to adopt that particular means of payment. So that these networks effects, they would push in principle towards an early entrant having significant advantages. But then at the same time, when it comes to these international discussions, my sense is that in the US, but also in Europe, I think the concerns about losing out to some other currencies that would become more digitally prevalent, so to speak, is very modest. I think in particular the US, people think that the world financial system is dollar-based, not because the dollar is a particularly useful means of payment in terms of user convenience or something like this, but it's really that there's many other factors that play in that direction, in terms of the rule of law in the US, about these broad and deep financial markets in the US, and many other factors. And this is really behind the fact that we invoice trade in dollars mostly, that many international payments are in US dollars, etc. So I think those fears that the entrance of a CBDC outside the US dollar system or the euro system, that would sort of lead us to adopt this new currency, is very limited in the US for sure. So again, my long answer short is, conceptually, I think yes, I think there should be a concern. In practical terms, my sense is that policymakers, certainly in the US and maybe also in Europe, are not too concerned about this right now. We saw a lot of that when it came to Libra. There clearly 2019 was a watershed moment. If you watched what the BIS and many central banks were saying about CBDC before 2019 was, this is all rubbish. It's basically the same as a cryptocurrency, so let's forget about it. And then in 2019, when Libra came to the fore, the discussion became much more serious, and the views that maybe we should offer something which is also useful to our customers, to our citizens, rather than letting Facebook take over, was clearly present. So maybe there's a bit of that discussion, but again, on the international sphere, my sense is that that notion is not that strong at this point.
Okay, thank you very much. And I think it's a good time to say that it was a highly thought-provoking presentation. Thanks for that, for Professor Niepelt, and thanks also for all the participants for the good questions and for this interactive discussion. I enjoyed a lot following that. So I think it's time for us. Yeah, thank you. Time for us to move on to the next session, which will continue and deepen on this same theme. And that will be chaired by Morten Beck from BIS Innovation Hub. So I give the floor and control, Morten, over to you.
Thank you very much, Matti. It's good to see you and Dirk again. And Dirk, thank you very much for setting the stage just perfectly for not only my session, but also the following session, which actually happens to have the same name, CBDC. So it's a very natural fit. I also just want to thank everybody for so far contributing to a great conference. Yeah, so far. So and we will definitely aim to not disappoint you for the rest of the day. But without any further ado, we will actually turn to the first session, and I'm very happy to see my old friend David Humphrey be presenting his paper on the falling use of cash and the demand for retail CBDC. And this paper would be discussed by my other friend Christina Pichillo, and she's currently at the Financial Stability Board. But I'll turn it over to you, David, and please take it away. Thank you.
Okay, thank you, Martin. This is just sort of a very much of a micro view of something as opposed to what Dirk talked about. We're talking really about the falling use of cash and how that might relate to issues regarding the demand for retail CBDC. These views are our own, and in fact, they should not be attributed to the IMF, where one of our authors, Tanning, is located. Let's see, okay, I have to use this. We have three goals, basically. We want to develop an indicator of cash use for payments, actual transactions rather than holding, and explain why cash use might be falling as we tend to measure it here, and to identify what we feel will be the determining factors and incentives or attributes of CBDC compared to its current large competitor, which would be cards. So without further ado, let's see here, the next card. Okay, how do I move these things around? Oh, maybe it comes out. Okay, navigate back. Okay, well, there's basically three measures of cash use that I present here. First of all, we have the standard measure of cash use, which is currency in circulation relative to GDP. And I've used this measure myself many times, but I'm not sure it affects very well for when we try to assess the sort of the competitive environment that CBDC might face, which would be cash versus cards versus CBDC. And for that reason, particularly since GDP is a function of all sorts of different types of payment instruments rather than at the POS, I might look for a more focused measure, which would be small values of currency in circulation relative to not GDP, but for household consumption where cash is more utilized, obviously. And thirdly, if I can get to, I can't, how do I move to the 26 here? Maybe you can tell me after here. I look at cash use as a market share. So we have cash as withdrawn from an ATM as a percentage of cash from ATMs plus the value of cards plus e-money. This is not the best measure that we could use because we don't have cash back at the point of sale. That information doesn't exist for the 25 countries we look at, nor do we get to have information that's separate on cash withdrawals by depositors from over-the-counter at their banks. What we do get for 6 countries in Europe is over-the-counter value of cash withdrawals, but that is, we believe, largely made up of something we don't want, which would be the value of cash withdrawn for business use for making change. So if I can go to the next, how do I get to the next one? I can't see where I get to my next goal here. What do I do? Maybe someone can break in here on the bottom of my screen, which I'm using my mouse to get to then. I can't seem to move the cards along. No.
We can also
yeah, go ahead.
Slides for you from here if you wish, but you
yes, please do. Well, yeah, because I can't see what I'm doing here. All right, go ahead. Why don't you? I'll just say, please change the card. Okay.
Okay, so we'll do that from here.
Okay, thank you. All right, we went through the third one, so please change the card. Yes, okay. Here we have 3 measures of cash use. The standard one shows that 8 countries fell in terms of their cash use relative to GDP, and that's the shaded portion here. If we use small value of currency in circulation, 13 countries fell. If we use our more focused one, more narrow version, almost all of the countries fell. Change the card, please. All right, this represents, I have 3 of these slides, but the first one here shows, in general, what happens to all of the countries, the 25 that we look at. And that is, as you can see, for Indonesia, Singapore, China, Australia, Japan, Korea, there's very little change in the cash share being used here over our time period, which is 2012 and 2019. It's a very slight reduction in average use. It's actually only about, what was it, 7.1 or 7.2 percentage points. However, for India and Russia, as you can see on the slide, there's quite a bit of a difference. For India, they early on in the time period we look at, 86% of their currency was declared to be illegal. And that was an effort to drive out black cash. And that also led to an effort to use something else other than cash for transactions. So that's India's situation. For Russia, don't go to Brazil yet. For Russia, we have a situation where sanctions by Western countries against the Russian banking system had some impact upon their payment system, and the central bank of Russia decided that they're going to issue their own card called MIR, M-I-R, and they are promoting it rather successfully against the other cards in the country, and they're promoting it in a sense of discounts. Please change the card. Okay, this is the last slide that shows all of the 25 countries. We have Brazil, which is the only one that's outstanding here. Actually, maybe it's the second one. And for Brazil, they had an economic difficulties in the beginning of our period, and also their central bank issued a card to try to increase competition in the payment system. And their card actually has any transaction issued by, or initiated, I should say, by an individual is free. The receiver, however, of the payment would actually pay something unless it's another individual. Next card, please. Okay, this is the last one, and this just really shows, as you'll see, as you've seen so far in all 3 here, that there's a very small change in the in this cash share here. Okay, next card. All right, the average reduction in percentage points is 1.7% a year. However, we have 8 countries here that have a cash share that's rather low, 6% to 20%. And for these countries, the cash share is, in terms of percentage point reduction, just 1.2 percentage points a year. And what this indicates to us, as well as other information, is that what's involved here is really sort of like an inverse logistic curve or a reverse Gompertz S-curve, namely that it starts to fall slightly in the beginning in terms of the cash share, reaches an inflection point, and then falls at a decreasing rate thereafter. But the more important point here to take away from this particular slide is that we've got a lot of first mover advantage for competition with CBDC, in the sense that 80% to 94% for the 8 countries we just mentioned and shown above have a very large share of that particular market. Next slide. What we have here is an effort to explain why this cash share is falling at a relatively slow but steady rate. And what we have at the top of figure 2 is actually just another representation of the 3 slides that you just saw. It looks like it's falling rather rapidly, but that's only because we've sort of truncated the time period on the x-axis. But it's really just the 3 slides we just saw before, and they're numbered by the various countries. And to try to explain this, we looked at some payment diary studies. Actually, there's only 6 payment diary studies that I've been able to find. And what they tend to show is that the share of cash transactions by younger adults seems to be lower. Seems to be lower. They opt for cash substitutes compared to older adults. And now that's in terms of shares, but what we're looking at here on this slide is actually a recalculation of that data over 3 years using US data to show, in fact, the total transactions and the total value spent. And what we see here is a marginal difference between younger adults and older adults in terms of cash shares. So how does that tie into anything? Younger adults and older adults, of course, they're not stable. Younger adults, more younger adults come into the population next year and the year after due to the birth rate, and older adults leave that population according to the death rate. So if you add the birth rate and the death rate together, you get an idea of what could be basically the change in the time series population age structure of a country associated with these revealed preference arrangements that we see from the payment diary studies for younger adults tending to favor on a marginal level cash as opposed to older adults. And the next slide, please. We'll actually try to relate the top and the bottom of the last slide you just saw. Here we have a sort of a standard money demand equation. We have the cash shares is a function of the sum of the birth rate plus the death rate, which changes the age structure of the population from year to year. Then we have an expenditure level of the household consumption, and finally the interest rate. And using this in a pooled regression analysis, fixed effects, where we have dummy variables basically for the means of the different countries that shift the intercept primarily. And we have the within effect. We see that the household consumption and the interest rate is neither one of those are statistically significant, but we have a negative relationship, which we expected here is strongly significant, and the R-square is like 0.97. Now that doesn't prove a whole lot, except for maybe the 6 countries that we looked at, because the rest of the countries we're assuming that they probably have the same sort of relationship. In fact, you get the same relationship we see here for our pooled results if we just use the simple passage of time. The only difference we're doing is trying to explain that with a hypothesis that it's related to the age structure of the population and reveal preference from what they seem to like one way or the other in terms of payments. Next slide, please. Okay. What we do here, and I'll sort of skip around to try to reduce the time, is first of all, we're basically assuming that whatever central banks decide to do with respect to issuing CBDC, they will actually succeed in providing many, if not all, of the same user attributes, both for the user and for the merchant, namely the consumer and the merchant, with respect to cards and with respect to cash. So our point is that there's got to be something more for CBDC to overcome what seemed to be the revealed preference and the first mover advantage for cards at the present time. Next slide, please. Okay, next slide, thank you. So we've identified out of these comparisons for looking at different attributes of cards versus CBDC that 3 things seem to be the most important, and they all relate to transaction fees or transaction cost. And the first component here would be just, is there going to be a user fee on the part of users of CBDC? Europe seems to, in their digital euro, seems to indicate, not a decision, I guess, at this point, but seems to indicate they're favoring that it should be free like cash. That means no user fee and no interchange fee. For the United States, it might be different due to the Monetary Control Act of 1980, which requires the Federal Reserve to price their payment instruments except cash. So I'm not sure that that's going to roll over for CBDC. In any event, if there's no user fee for the use of CBDC, then in that case, it's just like a card. So that's a benefit in that respect. But more importantly is the fact that with cards, you have usually very large interchange fee on the part of the receiver of the funds. And so consequently, it turns out that with those interchange fees, to the extent that merchants could get users to use CBDC and provide incentives to do so, those interchange fees would go away, and the merchants would probably feel a lot happier about the whole arrangement, unless they're already being able to surcharge fully for what those interchange fees are. So that aspect of the interchange fee on the part of cards, but maybe no interchange fee or very light interchange fee for CBDC, would suggest that in fact they could relatively easily, depending upon the difference in these interchange fees, if there were some, to be actually favored over cards. And the last element here would be that CBDC would be immediate payment. You go right to your bank, whether it's person-to-person payment or if it's a person to business or business to business, it really wouldn't matter here. That saves time, and it also saves money. Cards are currently 1 day or 3 day money, namely you don't get it until maybe after 3 days. So therefore you have to borrow funds to cover your working capital needs here. And the same thing sort of happens, but less so, in terms of cash that has to be deposited back to the bank to be reused. So cash is at least 1 day money, where small businesses might be able to deposit their cash holdings at the end of the day and not use them because the bank would be basically closed, or on 2 day money perhaps, or 3 day money for large retailers which would use armored couriers. So the advantage of retail CBDC would be that it's final payment immediately available, just like a fast payment that now exists. And some of these fast payment firms are owned by card firms. But that would clearly be an advantage for CBDC relative to cards. Those are the 3 elements we think will determine the acceptability and the adoption of CBDC relative to cards. Last slide, please. Again, last slide. Next slide. Okay, as a summary, what we've done is try to define what we think is perhaps a more useful measure of the competitive environment for retail CBDC as opposed to what is now typically used. And then we looked at revealed preference for cash substitutes using these payment diary studies, tied that to the age structure of the population, and we find that that seems to be nicely related to and explain the relatively slow pace of the reduction in cash use, cash share, I should say. And finally, we just outlined the 3 things that we think are most important going forward, as long as, in fact, CBDC is devised in such a way that it replicates the benefits that currently exist for cards. Thank you. That's my end.
Perfect. Thank you very much, David. Excellent presentation. Many interesting aspects. I'll turn it over to Christina now for the discussion. Also, David, thank you for staying within the allotted time. That's always appreciated. Thank you.
Thank you very much, Morten. And thank you for the opportunity to discuss this paper, which I really enjoyed reading. So before starting the discussion, let me say that these are my only views and do not represent the ones of the Financial Stability Board. So the paper contributes to 2 streams of literature, the decline in cash usage and cash substitution by cashless payment means, and one on CBDC design. And it does from providing a demand-side perspective. So which are the characteristics of the CBDC that create the appropriate incentives for users and merchants to be interested in adopting CBDC if this is made available to them. And the connection between the 2 topics is an interesting one. So the analysis of the retail payment landscape and the competition over time of different payment means is key to determine which are the characteristics a new payment mean, such as the CBDC, the retail CBDC, needs to have to be successfully picked up by users and by merchants. So rather than using measures of cash in circulation on GDP or of small denominations on household consumption, the paper uses a novel proxy of cash usage, namely the share of cash over the total sum of cash and cash retail payment transactions, and in particular card and e-money payments. And it finds that there is a substantial reduction in cash share in 24 of 25 countries in the sample between 2012 and 2019. It then analyzes the drivers of cash reduction and focuses on the younger generation's love for cashless. And the change in population's age structures is practiced by this interesting measure of cumulative sum of the individual and annual changes in the age structure, and they find negative statistical significant impact on cash share. And finally, they move into looking at the incentives for CBDC adoption in such competing landscape. So the lack of fees, particularly for merchant, might be relevant, but also the availability of funds. Even though some other incentives may have to be offered on top of that, more than the benefits of using accepting cards, in particular if fast payments are considered, which is not sufficiently considered in the supply side focused CBDC debate. At the same time, there are a few questions from my side on the link between the empirical part and the discussion of the retail CBDC demand side drive. It's to me not so clear why to focus on its adoption. Also, while multi-CBDC discussions are ongoing, they're very relevant for discussion on cross-border payments also at the FSB. It is very likely that CBDC will be issued at national level, if at all. And I'm just wondering to what extent results from a cross-jurisdictional panel can provide really meaningful insights for a decision on CBDC design, which will be purely issued in the national domain, and whose success will depend on the national. A few suggestions. As a data lover, I would be interested in reading more about the data sources used in this paper. While some of these are indicated, such the payments that are in US indicated. This is because it would be interesting for the reader, for example, if you think that, for
Christina,
example,
you're breaking up, so maybe
data
you
that
turn
we
off your
use
video.
for our paper on cash, certain data is not completely all. I'll be brief with a few more remarks. Can you hear me better? I hope so.
Try again.
It would be interesting. Can you hear me?
Yeah, but you're breaking up from time to time. Try again,
Okay.
please. But did you turn off your camera now?
Yes, I did.
Okay, excellent. Thank you.
So I hope it's better.
I think it is. Thanks.
Great. Sorry about that. So my further suggestion is I would be curious to see the results of some robustness checks with other proxies of intergenerational age change of the population. And this is because new birth may not necessarily be indicative of the current changes in the distribution in the population that does take spending decisions. So I was wondering if rather than the birth rate, it might be more interesting to see some lags, 14 or 18 years lagged birth rate included in your measure of intergenerational age change, or at least to see some robustness checks. And finally, it would be interesting to see some dummies referring that could capture reduced average card interchange fees. We heard about that in the first session of the conference, or permissions of search users in certain jurisdictions, as the authors in the papers point out that these are relevant for the discussion on incentives for CBDC adoption. Finally, what is the elephant in the room? Probably the COVID-19. So for any further extension, it would be interesting to hear if the developments in payment habits of COVID-19 that we heard about in a previous session made it easier or harder for a retail CBDC to be successfully adopted. So if cash reduction, the trend in cash reduction has accelerated for COVID-19, does it make it easier for retail CBDCs, or vice versa? Whether the new payment habits that have been adopted by a certain part of the population because of the pandemic would make it harder for CBDC to be adopted by these payers that have changed their payment habits recently. So let me stop here and thank you very much.
Thank you very much, Christina. David, I hope you heard some of Christina's very good questions and also suggestions. So let me first give you a chance to reply to some of those.
Well, I heard her, yes, but and I read the slides, so yes, I appreciate the suggestions. Actually, we don't have any ideas going forward. We're not going to be doing anything about COVID-19, but yes, that's a good point that, in fact, if any country wishes to use particularly this measure for determining what their cash share actually is before they make a final decision one way or the other with respect to CBDC, then obviously these things have to be considered, particularly COVID-19 use for cash versus something else, as well as the fact that you have a situation where we don't have the cash back at the point of sale, nor do we know the value of cash being withdrawn from banks by depositors, as opposed to depositors plus merchants using cash to make change. That's all I sort of recall at this point, but I'll be happy to reply to Christina once I see her slides in more detail, and can do that on a private network.
Okay, thank you, David. There's a number of questions also in the chat. I don't know whether you can see them. I can also read them out, or perhaps we can even, if people want to come in. The first one is from Peter Stella. So he asked you, would CBDC and cash in your model be closer substitutes for store value cards than credit debit cards, in that you could use it if you are not of legal age or not have or want a bank account, etc.? Over to you,
well,
David.
I would expect here, yeah, I'll reply. I would expect here that CBDC could be easily just for stored value cards, debit cards, and credit cards. It really doesn't matter here, I don't think. In fact, I think CBDC at some point will be a stored value type of arrangement anyway, at least for some users, just as perhaps for some users it might be anonymous for transactions, not for all transactions, but maybe of a certain limit. I'm not sure if that gets to the point here, legal age, not have a bank account, etc. So yes, I don't see any problem there. Let's see here. You've got another one from, if you want me to continue.
Please do, absolutely.
Okay. I can't see the name, ATTE, I guess, ATTE, says I like retail CBDC example and the immediate finality of the transaction within this set of design criteria to CBDC in terms of it being a bearing instrument. Well, I'm not sure it's a bearing instrument because how else can you get it but from a bank? I mean, unless the central bank gets it directly, but still you have to use deposit money to pay for it. That's what I didn't understand about the earlier presentation that we had today. It seemed to me that that the non-bank institutions, what are they going to do with the CBDC? They're not going to hold it, I don't think, in their own sort of wallet in some fashion. I mean, they might use it to invest in something else rather than a bank, but I think most people just put it right back in the bank again. That's where it came from. That's where it goes back to, just like a regular deposit money situation. That would be my view there. Also related. Okay, I'm not sure about this one.
I think Martin van Ort have raised his hand. So if you can unmute yourself,
Yeah,
you're
go
more
ahead.
than welcome to ask a question.
Thank you, Martin. And thank you, Dave, for the presentation. I believe you also wrote a working paper in 2019, IMF working paper. I remember I very much enjoyed reading that working paper as well. I only had kind of one question, and it's perhaps a little bit more a question like whether you could clarify a little bit like about the third measure that you had, where you're kind of dividing the like small currency by the sum of small currency plus card transactions, and I think also electronic money transactions. And one thing I was wondering about a little bit is the denominator here, is it not kind of a combination of both flows and stock variables? And if that's the case, should perhaps the amount of cash be multiplied with some kind of velocity in order to make sure that we kind of get that the denominators like just really flows?
Are you talking about essentially the final measure that we're using here, the more detailed thing, this cash share measure?
Yes, exactly.
Okay, well, I believe that the cash withdrawals from ATMs or elsewhere over the counter at banks would be a flow measure, right? Along with the flow of payments on the card side. Now, there is the issue that you've got, this is annual data, so there's some degree of overlap. You're withdrawing ATMs on the last day of the month or whatever prior to the next year, and that's a holding. But I think that that's relatively minor and would be offset by the fact of the prior year you'd have the same thing on the other side.
Sorry, Dave. I hadn't understood that you were actually looking at cash withdrawals, but that I fully agree that that cash withdrawals would be a flow variable as well. So that would work out perfectly.
Oh,
Thank you
okay,
for the clarification.
Okay. Right. I think you were just looking at the other measure of possible measure, what some people have used, which is the small value of currency and coin relative to, say, GDP or household consumption.
No,
Yeah.
no, exactly. Yes.
Mhm.
Thank you.
Small intervention here, asking the people discussing also to turn their cameras on, similarly as Martin was just doing, so we get more lively video.
Was that a question?
I think it was a command.
Oh, okay. Well, what was that?
But thank you,
What should I
Martin.
do?
No. Yeah, you can turn off your camera, I think.
Yeah, I did.
Yeah, I still don't see you, but that's fine. We have one more question in the chat, I see.
All right, I didn't see. Could you read it perhaps? Maybe I don't see it.
Yes. Cash withdrawals are the only reliable flow measure for cash, but with one withdrawal, one usually makes several transactions, yet haven't figured out how to measure this.
Well, I'm not sure it's something I need to worry about in the sense that the cash, I mean, actually some of the cash withdrawals will be used for illegal activity, which I can't include. And some of those cash withdrawals might be in some countries used a little bit for hoarding. But whatever is withdrawn at some point, we hope within the year, will pretty much be used for a transaction. So I don't think I need to determine the fact of how many transactions, it's just the value. In other words, it's the same thing as a card transaction. You add up the card transactions and you get a value. I'm not worried about how many transactions occur with cards. I'm worried about the overall value.
Excellent. I kind of realized, I think, no, that was actually a question for the previous session. Well, thank you very much, David. I think this was excellent. We will now go to the second paper presentation. So I invite the speakers and the discussants to show their faces using the camera. And I'm very pleased to hand the floor over to Kim Hyun on the demand for payment services and consumer welfare, the introduction of a central bank digital currency. I hope the paper and the presentation is as interesting as the title. Over to you. Thank you.
Sure. Well, thanks a lot, Morten, and thanks everyone else for attending this virtual workshop. If I can get control of the slides, please, that'd be much appreciated. While we wait for that, everything I say here in this paper, my views and my views only, and not the Bank of Canada. So,
Kim, you need to take control yourself.
Oh, yeah, okay.
Take control button.
Sorry about that.
Then you can repeat. Yes,
okay,
now.
Thank you. Yes, so let's dive into this. So we have a very normative question: should the Bank of Canada issue a CBDC? So Deputy Governor Tim Lane discusses this in his recent speech, discusses two conditions. First is whether the use of physical cash is reduced or eliminated altogether. Second is where private cryptocurrencies make serious inroads. And so there's the source of the speech. So in this paper, what we're going to do is we're going to try to address the first item. And we're going to focus on that in terms of the transactional motive for using cash. So at the point of sale, we do note that physical banknotes, the demand for it has been stable or rising in recent years, and even more sharply during the COVID pandemic. And Professor Seitz presented some of the work 2 days ago. It's been a blur, but so again, I was going to reset everybody to say that we're going to focus on the transactional demand and look at this condition number one. So what we're going to do in this paper is to think about this cash potential cash substitution between to debit and credit cards, and then ask that question: suppose we were to introduce a central bank digital currency. It's a new product. What would happen, right? So it's a what if analysis. And so the way I think about this is part of me, my research identity is entrenched in industrial organization, is to think about a new product that is a synthesis of previous products, the characteristics of it. And so the way we do this in industrial organization is to use what we call characteristics-based approach, which is we look at the features of a product, and then we take combinations of those features, and then we synthesize a new product, and then we see, well, what would be the demand response to this? Okay. And so one thing that we note, some of the empirical background is that consumer demand for cash at the point of sale declines, and part of it is due to some demographics, and so Dave talked about this previously. And what we have is stated preferences, right? These are the assessments that consumers make about certain products. Then, especially the alternative payment methods, debit and credit cards, and then recently some of the payment innovations that we have, which is contactless credit cards. Okay, you tap, right, and then you can make the payment and interact e-transfers. So I know a lot of people talk about Swish in Sweden. That's Canada's version of this P2P payment. At the same time, we know that payment markets are two-sided markets, right? There's consumers and merchants. So my adoption of a payment method also increases the adoption, the utility of adoption by others, other consumers and other merchants. And so therefore, in this empirical exercise that we're going to do, we're going to also embed merchant acceptance. So we know from our 2015 survey on merchants that cash is almost universally accepted by all merchants. Cards are universally accepted at all large businesses. That means chains and whatnot. Cards are only accepted by 2/3 of small, medium-sized businesses. So these are businesses, single locations, having less than 50 employees. And a very small number of these small businesses do not accept cash. So here's just restate the research contribution. We're going to try to understand what the main characteristics of consumer demand for usage and adoption of payment methods. We're going to look at these perceptions, ease of use, affordability of use, security of use, the other characteristics such as rewards, transaction costs, look at demographics, and then we're going to use a very rich set of transaction characteristics. Then once we estimate that model, we're going to use those estimates, and then we're going to synthesize some type of product. Is it going to be a cash-like CBDC, possibly a token? Is it going to be an account-based CBDC, very much like a debit card, or something that's best of both worlds? And these are all just basically on features or characteristics based. So I'm not a technologist. I don't know what the form of function looks like. But this is the feedback we do as the economists. We talk to the technologists, and this is the things that we do product design, right? So the way to think about this is the introduction of the minivan in the 70s and 80s. So Lee Iacocca, before he went to save Chrysler, he was working at GM, and the engineers at there said, well, we think about a van, right? A van is great, like a very big cube van. It can carry a lot of people, but it has very poor gas mileage. There's a sedan. The sedan has very good gas mileage, but can't carry as many people. So then, what do? They synthesize all the best features of that cube van and that sedan combined together. Voila, that's the minivan. And so that's the idea behind this this empirical exercise. So what do we find? If I run out of time, that in the best case scenario, the CBDC can gain a market share of 25% under full adoption and acceptance. So that's an extremely rosy scenario. Consumer welfare is about a maximum of $2 per month in welfare increase for users on average under the rosy scenario. We'll, of course, see some distributional effects, and I'll go through some of those results. So there's an extensive literature about this. So Petrin, new product introduction by Petrin. And of course, there's a whole bunch of work in the amongst payment economists, and many of these papers have been previously presented at previous economics of payments workshops. So this paper is really based on the two-sided markets model by myself, Nichols, and Sherbakov in 2019, which was presented previously at the economics of payments. So what we're going to do is, in that paper, we fully specified and estimated consumer and merchant decisions. So what happens is that consumers adopt a bundle of payment methods: cash and debit, cash, debit, and credit. And when they do this, they are conditioning on what would be the average acceptance by the merchants, right? So the merchants have a decision to accept cash. They can accept cash and debit, or they can accept cash, debit, and credit. And so the merchants undertake these decisions against the background of what consumers are doing. And then, so this two-sided markets model has this as the first stage, the adoption decision. So once consumers adopt the bundle, the merchants have an acceptance bundle, then there's a usage part, the second stage. And then in that case, consumers and merchants in this formula, in this picture, they're matched. So suppose myself, right? So I've got some product from my employer. So I have a $100 bill, I have cash, I have a debit card, got a credit card. I get matched to a merchant that only accepts cash. Well, then in that case, I have to use this $100 note. Okay, and so that's what's happening in this model framework. So what we're going to do in this paper is that to make the problem much more tractable, we're just going to treat the merchant acceptance decision as parametric. Okay, we're going to run through a scenario of different levels of merchant acceptance, and then let the variation of the consumer side identify the preference parameters. Let's skip all this math because I think it's going to run out of time. But let me show you what happens in the first stage. So in the first stage, there's the expected utility of this consumer. They drive utility, right, based on the bundles, subtract by what we call the fixed cost parameter, or the adoption cost or benefit of having that adoption decision. So we know that this, then we'll have it in much of the empirical I/O literature, this error term will be a standard Gumbel distribution. So that will generate logit, right? So these are the first stage adoption costs, right? So there's the bundle of just cash, there's the bundle of cash and debit, and the full bundle of cash, debit, and credit. And once we do that, right, there's that first stage. What's the probable? That's this is the compound likelihood, right? There's that. There's the probability of all these adoption decisions, and then once the adoption decisions are made, then there is the usage part. Okay, and so we're going to estimate that by simulated maximum likelihood. So we're going to use data from the consumer side, from the survey questionnaire that we have, and the diary, 3-day diary that we've been running, 2009, 13, and 17. And then what we're going to do is we need some more what we call subvariation to understand, especially at the adoption decision. So we're going to do some probabilistic matching on characteristics of the consumer to this credit registry to get the credit score. Because in Canada, that's how you get these things, right? You have a high credit score, you get really good terms. You have a pretty low credit score, you're not going to get one of these things. So in terms of the what we call the assessments or the perceptions, we look at the ratings by cash-only users, cash and debit card users, and the full bundle. So you can see the relative ratings of ease of use, affordability, security, and acceptance. Okay, so you can see the cash users, they really like cash relative to debit and credit cards, whereas the full bundle, the difference in assessments are not that large. Okay, so these are what we call stated preferences. This is what we're going to do. We're going to use this to estimate the stated preferences to get those parameters. And then after that, we're going to do the counterfactual. So for those who are curious, here's the the demographic distribution for the method of payment bundles in 2017. You can see the cash users tend to be a bit younger. They have lower income. They're less educated. They tend to be less urban. Their employment status is much lower. And the adoption of usage of smartphones is lower. In terms of the empirical shares, well, let's just focus on 2017. Right? So the dominant methods for cash is highlighted in orange. So you can see in 2009, there was many more categories, but by the time 2017 rolls around, you can see that cash is the most dominant for these categories: professional and personal services, travel and parking, entertainment, meals, and other. So those are the transaction shares that we compute from our 3-day diary. So this is not the greatest picture, sorry, the regression, the estimates from the mixed logit that we estimate. I just wanted to let you know that there's a first stage estimate based on those fixed costs here, right? And those fixed costs are then feed into the second stage of all these assessments. But, instead of looking at coefficients of these type of discrete choice models, we're going to just translate it into what we call the utility of payments. So we're going to take those 5 features and then map it into, well, what's the contribution per dollar contribution into utility. So you can see for cash, ease of use is almost $2. Affordability is about $1. Security use is a few cents. Of course, there's a transaction cost to using cash. So those stated preferences are lower. You can see for debit cards, the transaction cost is much higher. And then in the credit card case, the ease of use is very high. The transaction costs are very low from the consumer's perspective, and then also there's rewards. So that's a sanity check that these estimates are credible. So then in terms of the adoption benefits or costs, what we're going to do is we're not just going to treat it as this fixed cost parameter. It's going to be a function of your credit score. So we had models that we had these fixed adoption costs, but then in this mixed logit formulation, we're going to have the credit score. We're going to estimate this parameter. So think about it this way. A very good credit score would be 800. 800 divided by 100 is 8. 8 times 0.5 is $4. It's basically going to be 2.5. Sorry. How did that happen? That's going to lead into, for someone with a credit score 800, to $2.50 benefit, okay, not a cost. So in this case, there's that cost parameter, but as your credit score increases, right, you're going to get a benefit from adopting the credit card. So that makes sense, right? So if you have a very low credit score, say 300, right, it's basically, you know, you're breaking even on the terms of those adoption benefits, because you probably have to pay or you have to prepay the credit card of some sort. Okay, so now what we're going to do is we got those estimates. What we're going to do is we're going to run a whole bunch of what we call counterfactual exercises. We're going to introduce this CBDC. So this is the utopia for all the CBDC enthusiasts. That means there's going to be 100% adoption by consumers and 100% acceptance by merchants. So that every consumer is going to have this CBDC in their, I don't know where it's going to reside, pocket, brain, wearable, I really don't know. And the merchant at the same time is also going to accept the CBDC. So that's what we call the full adoption scenario. And then there's going to be the no full adoption scenario. In that case, then we can, in that counterfactual, the adoption and acceptance will have to be computed. So in this case, there's the normal bundle, then you have the cash and CBDC, cash debit and CBDC, cash debit and credit and CBDC, and same thing on the other side of the market for merchants. Okay, so in the interest of time, I think I have less than 5 minutes. Is it 5 minutes or 4 minutes? But there's in the paper we have 3 different scenarios: a cash-like CBDC, a debit card-like CBDC, and a best feature CBDC. So let's go to the best case in the world. So that's what we're going to do. Is we're going to take all those features of CBDC, sorry, of the assessments of cash and debit, which was the best in each case, and then for that consumer, raise that assessment up to the level of the best feature. So that we'll call that CBDC. Okay, and then we'll simulate what happens. So of course, anytime we do some type of counterfactual, we have to have a whole bunch of caveats. So we assume that there's no competitive response from banks and merchants. It does not take into full account the possible digital or P2P usage of CBDC, right? So it could be used for this to, as a Interac e-transfer. And we don't consider any of the potential of new applications to CBDC, such as programmable money, smart contracts. If you stick around, the next paper will talk about that by our colleagues at the Bank of Canada. Okay, so let's just go to the scenario number 3, the best feature of CBDC with full consumer adoption and merchant acceptance. So on the left-hand side of the bar of this pie chart, this was the observed payment shares. Cash had 34%, debit had 25%, and credit had 41%. Once we simulate this CBDC, which is the best of both cash and debit, it's not surprising that CBDC under full consumer adoption and merchant acceptance would gain a 25% market share. And you can see it's taking quite a bit from cash, 14%, and a bit from, 8% from debit and 3% from credit. Okay, and so that's and that's not surprising, right? Because the way we simulated it's the best of both worlds, best of both cash and debit. Okay, so let's go to consumer welfare. Here we look at the utility improvement of having CBDC with full consumer adoption and merchant acceptance. You can see there's educational levels. Some educational levels have higher valuation, right? So for a person like myself who went to grad school, I have a much lower valuation than someone who went to high school. And then you can see that in terms of you can see that in terms of the of age cohorts too. There's an age cohort that has the high valuation, and in terms of income, the lower income has a higher valuation than the higher income. Okay, so I think I'll end there. See, there's a lot of questions already. Is it possible also to promote co-author Alex Sherbakov and Josip Molnar, who's also on the call, and we can take questions. Thanks.
Thank you very much. A very great presentation. Yes, it's exciting. There's already a number of good questions in the chat. But before we get to those, I want to hand over the floor to Thomas Nellen, who will provide I'm sure, excellent discussion. Over to you, Thomas. Thank you.
Do you hear me, Morten?
We hear you.
Right.
And now I see your slides also.
Yeah.
Amazing.
Great. So let me first express a big thank you to the organizers, and let me also thank you for the invitation to discuss this excellent paper by Kim and co-authors. So as I work for the SNB, the usual caveats apply. As I said, we face a very excellent paper that is topical and that greatly contributes to the economics of payment field, in that it formulates a structural demand model for payment instruments, something I would say pretty novel here, and that in a two-sided market setup. So also thinking about the previous companion paper of three of the co-authors. So it additionally adds to this paper that it estimates and simulates this model in a probably reduced way. So since I think this is a pretty novel way to think about payment instrument demand, I would primarily understand my job here as in the evaluation and hopefully suggestions of valuable ways to actually improve the credibility of such a model or approach. As Kim has or did a great job in explaining the paper, himself already know. I just directly jump to the discussion. And I would like to start with something or some issues that I called more fundamental issues. So the first one is related to the functional view of money that suggests that next to the exchange of value function, also the store of value function plays an important role in at least the adoption decision for payment instruments or for money, if you want so. And this in turn, of course, also influences the usage decision. So there is actually another paper by Lee, also a Bank of Canada fellow, that considers the interest rate as a potential way to include the store of value function, but you may of course also think about other dimensions. And one among the more prominent ones in the discussion of CBDC is of course the safety of the store of value. So whether you have CBDC or commercial bank money can greatly change things. This is certainly also connected kind of to the security or theft considerations that are somehow evaluated in these kind of surveys from which the data stem. Could also be related to trust in banks. Maybe other variables can help here. Then if we think about payment instruments, we also think about bank services, which is also done in Lee. So banks usually kind of offer bundles of bank services and payment instruments together. So the basic bank account also includes a debit card usually. And maybe there is something to be paid for credit cards. No? Authors themselves in the paper also mentioned the credit function of the credit card. So maybe that's another way to go forward. Then another issue is related exclusively to the exchange of value function. So here I would say that that's the value added of the paper, but also maybe a critical point of the paper that they use a goods demand model which may not truly fit the question at hand. No? So maybe that kind of criticism is related to my exposure of new monetary economics or my little exposure to new monetary economics. But in terms of usage of payment instruments, I would not think of maximizing utility, but I would rather think of minimizing pecuniary or non-pecuniary costs, kind of subject to a notion of liquidity. So you want to kind of maximize the likelihood to meet payment obligations when you wish for to do so in order to actually maximize consumption utility, you know. So while the first two problems, so the utility maximization or minimization of costs might be one and the same, not just looking at it from one or the other side, it's about the constraints that you add to this problem, and maybe it would be helpful to think about adding some kind of liquidity constraints in that sense, no? And one simple example to add here would be that in order to do online purchases, you need kind of a credit card or some other way to do online payments. No? So another issue is related to the authors themselves kind of take account of that there is a lot of heterogeneity in payment instrument usage, no? And it's a well-established fact in the literature, so to speak, one that we're still trying to solve, is that the payment instrument characteristics and socio-demographic variables are known to be not sufficient to explain the observed heterogeneity in payment instrument usage. So one way the literature evolved is to add motives to these kind of variables, so to the characteristics and socio-demographic variables. And that's also related, or one of the aspects that is more important here is the budget control function of non-recurring payments that seems to play a role in the adoption and usage of payment instruments. And here cash is valued very well, at least by Swiss consumers, which might not be the case for other countries, but it seems to be the case also for German consumers. But yeah. And then you see that this is very much different for the different payment instruments. We also had an evaluation of mobile payment apps actually here. So I think that would be helpful to think about how to introduce that, and I think Lee in some or the other way has done so too. So what else is important in relation to an empirical paper? It's the usual question: what is the past a good guide for the future? And I think Christina has also addressed it in the discussion of the paper before by David. The elephant in the room is the pandemic, no? And that probably relates in particular, I would say, to the merchant acceptance. So the question here is, are merchant bonds adequately chosen both before the pandemic and during the pandemic? So looking at their data before the pandemic, it seems to be right, but we also have examples that the merchant acceptance was heterogeneous also before the pandemic. And it certainly became different during the pandemic, where certain shops either kind of kindly requested customers to not use cash or completely didn't accept cash at all. So this kind of changed the perception probably of merchants on what's possible and what's not possible, and it's highly questionable what's going to be the case after the pandemic. Maybe there are other developments too that matter. So new payment instruments actually enter the scenery. So mobile payments is certainly one thing. Credit cards become e-commerce capable. There might be other entrants in the form of new money, so that the market is as dynamic as it hasn't been for a long time, I guess. So in order to kind of cope with all these issues, maybe one way forward would be to provide a proof of concept that would be very nice to have. So why, as a suggestion, don't you try to actually use the model to do something with a payment instrument that actually exists? So for instance, the introduction of contactless payments. Probably interesting is also mobile payments. That might be even newer, depending on the country we look at, I guess. And another way to go forward probably could be to actually use 2021 data. I don't know exactly, but it looked to me that the Bank of Canada survey is going to take place all 4 years, at least when looking at the years you actually used, or the surveys you used for your paper. So kind of switching to more methodological issues, one question I stumbled over was the objective cost estimate, and I looked at the paper from where you got this. So here the issue for me is that it's a measure that is equal and static and objective, in the sense that it looks at the cost that consumers actually face, instead of it being a variable and an individual perception of costs that may actually strongly deviate from objective costs that consumers have to pay when using payment instruments. And that's, or the latter actually is something we ask about in the Swiss survey. So we really ask them, what's your perception about the costs you occur, and two things strike out, so that they are not equal in the sense that they're not equal to the objective costs that are actually there, and they change over time. So what we see here, for instance, is that the cost perception of cash became less favorable for cash, but more favorable during the last 3 years for mobile payments. So I asked myself, what's the relation between affordability and the objective cost measure you actually use? And and it seemed to me that these objective cost estimates, they actually do a great deal in terms of influencing the welfare measure you gain. So the question is, well, what would change if you skip that and kind of replace it with a more subjective cost estimate of the payment instruments? And that's really what your model behind does. Not it looks at the consumer welfare, and that's heavily influenced by the subjective cost measure and not by an objective measure, I would say. In terms of the time, let's skip the first two. I think they're very much model related and unlikely to be changed easy, but maybe worth to be explained more deeply in the paper why it doesn't really matter that you take these assumptions. The third bullet relates to the consumer bundles. So looking at least at the Swiss case, what we see often is consumers that use debit cards, but they simply use debit cards to be able to withdraw cash, but seldomly actually really pay with the debit card, if not at all. So there is a certain fraction of consumers that do that, and that would probably change your assumption in terms of consumer bundles. Another thing I stumbled over was the credit score that you use to estimate the adoption costs. So at least in my understanding, a credit score would be kind of a cutoff that defines the eligibility to adopt credit cards. And yeah, the way you apply it is in a linear fashion. So the costs of adoption of credit cards changes with the credit score in a linear fashion. And I wonder whether that's a good way to go. And to me, it was also unclear whether that should really play a role with regard to debit card. At least in my understanding, or in the Swiss case, there would be no cutoffs in relation to the debit card, if you look at the credit worthiness of a bank customer. Then I wondered also about the motivation of a smartphone usage. So it was not clear why you actually introduced that. To me, it certainly relates probably to what you want, that the adoption kind of changes when you go from cash to more digital payment instruments. But then I wondered whether you should rather use it to kind of estimate adoption costs, and that's also related to the fact that
Thomas,
yes,
we have. If we want to give the authors a chance to reply to many of your great questions, I think we need to wrap it up. Also, otherwise we won't get to some of the questions in the chat as well.
Yeah, sure. So let me quickly wrap up the most important stuff. So here we just discussed 3 additional controls that may be worth considering. The policy discussion is related to the decline of cash. No? So you have experienced a decline of cash during these years, and the model predicts actually a similar decline in cash when you introduce CBDC. So in relation to what you also referred to in terms of what the Bank of Canada wants to do or plans to do when considering the introduction of CBDCs is to look at the disappearance of cash. So one way to frame this actually is that CBDC could be the death blow of cash, considering that it's going to further reduce cash usage quite dramatically, as you show, no? And what I really wonder also about is the welfare implication if you look at 2021 numbers. So as something that also was expressed by Christina in the discussion of the former paper, no? So cash substitution takes place, and that's probably going to be very impactful in terms of the reduction of the welfare gains of the introduction of CBDC. So yeah, very timely, interesting, and skillful paper that addresses a very difficult question and goes a very long way in doing so. And maybe you could still improve on what you have already achieved. So congratulations to the great paper. Thank you.
Thank you very much, Thomas. To the authors, you have about 5 minutes to address Thomas's excellent discussion, but also the questions that you would like to address in the chat. So I don't know whether you're going to share it or you are going to reply, Kim. Thank you.
Alex, do you want to? I'll give you a shot.
Yeah, thank you. Hi, everyone. Yeah, I would like to just respond to a very few comments. So first thing to remember is that the functional of cache or other kind of attributes, whenever it's providing, other possibilities, say online possibilities, it is worth, mentioning that we estimate two costs: the fixed cost of adoption or benefit of adoption, and sort of usage component of it. So fixed cost by definition doesn't depend on the usage. So anything which was mentioned actually in this discussion would probably be subsumed into the number. So which makes kind of harder to interpret the estimate of the benefit itself, because it would encapsulate many things, including the functionality of cash as store of value, including say benefits from borrowing if you have credit card and other things. So again, it's not really nice answer, but we kind of account for that. So it just means that we probably get the usage stage right. Another thing about bundles, yeah, so we actually define adoption costs or benefits at the bundle level, and that's exactly the reason, as you mentioned, there might be some synergy. So if you get credit card account, debit card account, it may be easier to get the other card. So that's why we actually do not have adoption cost for credit and additive cost for debit. We have actually bundle level. Regarding minimization of costs, honestly, I personally share your view. I do think that consumers do minimize costs. The ice cream is not tastier when you pay with credit card. But it seems that the other crowd, particularly those who referee our papers at peer review journals, have totally opposite view. And most of the time, we actually face critique. We actually have earlier paper which focuses purely on cost minimization. And most of the critique was, yeah, consumers may derive some utility from using payment options. And so, yeah, and in addition to that, it actually doesn't matter in our case, because holding demand for transactions fixed, and if you recall, we assume it's inelastic. Utility maximization and cost minimization with, as you mentioned, non-pecuniary elements would be identical. Another thing is, yeah, affordability versus objective costs. Well, the only problem with I totally agree that the perceptions are probably more important than the realization, even though we put slightly different interpretations. So affordability in our case is rather expectation of costs, and whatever you call objective cost is the realization of that. So in that context, it makes kind of sense to use them both, and they will both inform about different things. And as I have to mention that affordability has a problem because it's measured at consumer level, so how consumer perceives different payment options, while the objective cost is actually at transaction level, and that's important. Moreover, we actually find that transaction cost, the objective transaction cost, is the best predictor of consumer choice at the point of sale, which so has the biggest impact. And last thing, yeah, so. You talk about credit score being predictor. Yes, I agree. Credit score is one dimension of getting credit card, but you can also think of not binary relationship. Like if you pass some credit score, you get credit card. Think of, you know, every level of credit score is assigned a particular level of quality of credit card, say giving rewards or maybe charging fees. And so in that sense, you know, fixed adoption cost of credit card or the bundle containing credit card would sort of depend continuously. And yeah, it may not be, you know, linear. We may want to include other, you know, terms, but just think of it, it's a linear approximation to it. Yeah, thank you for taking too much time, and I very much appreciate your comments, particularly those at the end where you know, recommend us to do for 2021. That's a great idea. Thank you very much. We'll definitely do that. And thanks a lot for your thoughtful discussion. Thank you.
Thank you very much. I have a feeling that Matti is itching to get onto the stage. I think he has an announcement about a conference photo, if I understood correctly. So Matti, back to you.
Okay, very good. Thanks for the introduction for the theme, Morten. And although we are having a fully virtual conference, I think we need to keep some traditions, and one of the traditions is to take a photo as a memory of the event. So before we head to the small break, we try to do that now in this virtual environment. And that means that I will ask every one of you to turn on your cameras. So then we can see how we can capture the faces of all the people. It's nice to see so many familiar faces, and now everyone please turn on the camera. So
We are ready to continue. I hope you can hear me well. My name is Alexei Grimm from the Bank of Finland. I'll be chairing the second session on CBDC, session number 6. And the first paper we have today will be presented by Yuju from the Bank of Canada. We have 20 minutes for the presentation, and then another 10 for the discussant, and then another 10 for Q&A. But without any further ado, please go ahead.
Okay, so I take control. Okay. Can you see the slides? Okay, that's good. So thank you very much for including this paper into the program, and it's a wonderful conference. I have been learning a lot so far. This is a joint work with Charlie Ken and Martin Van Noort, and my co-author Martin is in the audience, I think, and he can answer questions in the chat, I think. Okay, so in this paper, we try to look at the design feature of a CBDC. What we are proposing is to use an expiry date to facilitate loss recovery if the CBDC allows for offline payment feature. Okay, first the question is why offline? As we all know that a big advantage of physical cash is its resilience. It can be used even if the internet is down. This is quite useful in transactions in remote locations where there's no internet, and in the event of natural disasters, cyber attack, or other type of lack of connectivity. So we think it's a good idea to have the similar feature in a CBDC. In fact, many countries, many central banks are thinking about that too. But what we argue is that an implication of this offline payment feature is that the balance that can be used in offline transactions have to be stored uniquely in a tamper-resistant devices. That makes it possible to lose a device and hence lose a balance. The first question is, why can't we have backups? Well, this is really because of a double spending problem. Suppose we have this balance in a device and also have it on in the online account. Then you can think one can use the offline balance with the device at an offline location and also use the same balance online, because the offline location by definition does not have instantaneous connection to the internet, so you cannot verify whether the money has been spent or not. This opens door for double spending problem. A similar problem would occur if you can back up the device, the balance in a separate offline device, so you can use the same balance using different devices and 2 offline locations. Okay, so to rule out this double spending problem, that means we have to store the balances uniquely in a tamper-resistant device, and it has to be separated from the online funding. A consequence of that is that if we lose a device, we lose a fund. Okay, that can be very costly. How costly is that? Is that really real? Yeah, we actually conduct a Google survey asking people whether they have lost their payment card or phone in the last year. It turns out around 16% of people has lost their payment card in the previous year, and around 8% of people has lost their phone. If you compare this to interest rate, that's much higher. Okay, so we think this is a real thing. Then, given this is a real thing, we are asking this question: can we somehow reduce the cost of losses in the case of a digital payment instrument? What we think the answer is yes, we can do that with an expiry date. The basic idea is whenever you download money to your offline payment device, there is an expiry date attached to that balances. If the central bank did find no one has claimed that offline money before the expiry date, then after the expiry date, it automatically reimburses the money. So then this leads to some interesting economic questions that we want to focus on in this paper. First, it's about the information strategy. What type of information should the device, if it connects to the central bank ledger, share with the central bank? I will be more specific about that in 2 slides. Another question is, how do we optimally set the expiry date? How long it should be? Okay, what has a trade-off involved? That's our focus. Before I go to the details of the economics, I will first show you a picture of a digital Canadian app and to show our idea. So it's in this app, it says there is a total balance of 432 and 120 is offline balances. At the bottom of the app, you can see there is an option saying enable loss recovery. Once you do that, an expiry date just show up there. And also you have another option to say you automatically renew the expiry date when you connect to the internet. So whenever you sync your device, the expiry date is renewed automatically. Okay, now let's go to the information. What are we talking about in terms of information? This involves the idea, if we reimburse the money, to whom we should reimburse money? Who lost the money? It could be the original owner who downloads the money into his device. Before he can spend it, he lost his device. It could also be he has already spent the balance, and by paying someone, but the payee lost his device. Then there is a question to whom we can or we should reimburse this money. It turns out that depends on the information structures, what information the device share with the central bank. If whenever we connect the device, okay, we consider two information sharing strategy. Now, first is a high privacy case. That basically says whenever we sync our device, the device does not reveal where and how much I spend the offline balances. In that case, the payee have to deposit the balance before the expiry date. If they fail to do so, then the central bank does not have additional information, so it reimburses the money back to the original owner. That's a payer instead of the payee. That's a high privacy case. We also consider the case of a low privacy setup, where when you sync your device, it reveals how much you spent the money. In that case, payee still need to deposit the balance before the expiry date, but he has an extra insurance that basically says if he loses the device, and if the payer chooses to sync his device, in that case, the central bank knows it's a payee who lost the money, then the payee will get the money instead of a payer. We also investigate how to optimally set up the expiry date. But let me just show you the results, the summaries of the results. First, loss recovery with the help of an expiry date could have a substantial positive impact on the demand for offline digital currency balances. That's fairly intuitive because it reduces the cost of holding offline payment balances. Without an expiry date and loss recovery, if you lose the money, you don't have it anymore. But with the help of loss recovery, you don't lose it, you just wait a little bit to get it back. So that substantially reduces the cost and increases the demand. Second, more information between the pairs between the device and the central bank can potentially improve the loss recovery accuracy, because sometimes you would get to know it's the payee, not the payer, who lost the money. But that's not necessarily welfare improving. In fact, that could reduce welfare in some cases. This is because now the payer has a choice to make. He might strategically choose not to connect his device back to the internet, and that could have negative implication on welfare. And lastly, there is a asymmetry in setting the optimal expiry date. If we set an expiry date that's too long, that's optimal, that the negative impact on welfare is small. But if we set it too short, the impact is very large. The intuition is quite straightforward because if you set the expiry date too long, what happens is if I lost the money, if I lose the money, I have to wait slightly longer to get it back. But that's not very costly because I'm patient. Okay, but if we set the expiry date that's too short, sellers would realize that he might not get a chance to deposit money, then he would not get the money. Then he would reject offline payment balances, and transaction and consumption cannot happen. That's very bad for welfare. Okay. So in the rest of the talk, I will just illustrate a small model that just clarifies all these trade-offs, and I will show you sub-result, a collaboration result from a bigger model where we have an infinite horizon, and to illustrate the asymmetry in choosing the optimal expiry date. Okay, so in this paper, we are going to, in particular, focusing on the event of an outage. So to think about use of offline money in the outage scenario. And during the rest of the talk, whenever I say cash, I really just mean offline money. That's a bearer instrument that can be used for offline payment. It could be a store value in a payment card or smartphone chip. And this cash allows for payments during outage, but it's subject to loss. Okay, so the simple model has 4 periods. In period 0, the consumer decides how much cash to hold and how much online balance to hold. The online balance pays some interest I, but the offline balance do not. After that, he receives a random preference shock. He might want to consume 1 or 2 units according to this shock in the next period. Okay, and t equals 1, there are 2 independent random shocks realized. First is an outage shock. An outage could occur. In that case, a network connection would be disrupted. After that, consumer could also lose his offline money, just lose his device. And then the consumer just go out and buy goods from the producers. He can use online deposit and offline balances if there is no outage. But if there is an outage, only offline cash can be used. And the consumption is going to be bounded by the balances that's available for transaction. It's standard caching and once constraint. And if there is no outage, at the end of this period, the consumer can deposit the offline cash back to his online account. And t equals 2, if there were an outage, then the outage first ends. After that, the producer may also lose his device and hence lose the offline balances he received with some probability eta. After that, everybody gets to withdraw and deposit their cash. If there were an online payment that arrived at this period at this point, and time equals 3, everybody just enjoy counting their money. Okay, so now let's solve the model. First, think about the case we have no expiry date. So a money lost, then that's lost. It never comes back. So that's like a physical cash case. First, we figure out the terms of trade. In this model, the competitive producer just do marginal cost pricing, and we assume their marginal cost, or you normalize that to be 1. So in that case, if there is no outage and the consumer paid by online balances, the price he's facing is just 1 covers the cost. But if he has to pay with offline balances, the producer has to be compensated for the possibility he can lose his device and lose the money. Therefore, he will surcharge compared to the online balance. The price would be 1 divided by 1 minus eta. That's compensating for the loss probability. We focus on the case that the buyers the consumer's utility from consumption is sufficiently high, so there is gains of trade. Okay. Now we figured out the terms of trade, and then we go back to think about the cash holding of the consumer. So the consumer might hold enough to purchase 1 or 2 units, depending on whether the benefits exceeds the cost. And the benefits comes from the consumer would be able to consume with more balances in the outage event. And the cost comes from the fact he has to get rid of the interest, and also there will be a cost from loss event. And we can solve the model. It's quite simple, but the bottom line is that bringing enough for the second unit is more demanding. And this is only because only with some probability the agent wants to consume the second unit, but he always wants to consume the first unit. And in terms of welfare, it's increasing in the number expected consumption. So more consumption, it is welfare is higher. Okay, now we have that with no expiry date. Then let's think about we introduce the expiry date, but the cash just expires too quickly. It expires after 1 period. That's at the beginning of the second period before the producer get a chance to deposit the offline cash received. Then in that case, because no information has been shared with the central bank will automatically reimburse the money back to the consumer. And producer realized that even if he produces and receives the money, he will not get it at the end of the day because of the expiry date. So he will reject any offline payment balances, and no transaction occurs during the outage. So that's really bad. In this case, the welfare is reduced compared to the case without expiry date. Okay. Now let's think about the expiry date is longer, so the money, the offline balances last for 2 periods. And first, let's focus on the high privacy case. So that is, the device does not reveal where and how much the consumer spends the money, so the money will be reimbursed back to the consumer if it's not claimed before the expiry date. So in that case, all the offers would occur as if there were no expiry date. So it's the terms of trade are exactly the same as a case without an expiry date. In terms of money holding, in fact, in this case, consumer would hold more money because the cost of loss is reduced. Without an expiry date, if he loses the money is gone. But in this case, he can get it back just with some delay. Because the consumer would like to hold more money, as money demand is higher, he's able to consume more under certain parameters in outage event that improves welfare compared to the case without an expiry date. Okay, now let's look at a case with low privacy. That's really when the consumer connects his device that would reveal where he spends money and how much he spends money. Now the consumer has a choice to make whether he reconnect his device after the outage or not. Of course, those consumers who spend all their offline balances, they do not reconnect because there's no benefit from reconnecting. And if they don't reconnect, they can still bet on the chance that the producer lose his device, then he can get all his spend balance back. That occurs with eta probability. But for these consumer with unspent cash, they are facing a trade-off. If they reconnect, they can deposit back the unspent money and earn some interest. That's I. But if they don't reconnect, they can get their spent money back with some probability, eta. So at the end of the day, whether they reconnect or not depends on whether the interest is higher than the probability the producer loses his device. If the interest is higher than that, Then the consumer will reconnect, and producer realize that the consumer would reconnect. That gives them extra insurance. So their loss probability of money would be lower. Although even if they lose their device, the producer would reconnect. In some cases, they can get their money back. Therefore, they will reduce the price of the goods. That means the consumer can buy more with the same amount of cash bringing into the outage period. That could increase consumption and can improve welfare in some situations. Not always, but can improve welfare under certain conditions. We characterize the condition in the paper. But if the interest rate is lower than the loss event, the probability of loss from the producers, then these consumers would not reconnect. And this would only increase the cost of precautionary cash holding for the consumers. Because if you think about that is a case with high privacy, the consumer could get both, right? He can get the interest at the same time because the device does not reveal where he lost the money. He can also get his spent money back with some probability. But now he can only choose one. He either gets the interest or he gets the spent money back with some probability. That basically increases the cost for the consumer to bring in cash, and that would reduce the cash demand and reduce consumption outage. That would reduce welfare. Okay.
You can wrap up in a couple of minutes. That would be great.
Yeah, for sure. I just have 2 minutes maybe. So we have a bigger model in the paper, and we calibrate the model parameters to the data, and we just try to think about what's the optimal expiry date. And here as a result, first I plot cash holding as a function of the length of expiry date, and that's shown here. The horizontal line is expiry date, and you can see that the maximum cash holding is attained at around 20. And you can clearly see the asymmetry here. If the expiry date is shorter than the optimal, then the cash demand reduces fairly quickly. But if it's the expiry date is longer than the optimal, the cash demand essentially keeps constant in the right panel, but in the left panel, but it's not really constant. If we zoom out, that's shown in the right panel. It does decrease, but just slowly. That's just what I said. In that case, you just wait a bit longer. That's not very costly because people are patient. As the next graph is about welfare, we get exactly the same message. So let me just wrap up. So we find that loss recovery could improve welfare and demand for offline payment balances. And when we set the expiry date, a longer one does not really have much negative impact on welfare, but a shorter one is really bad. And lastly, we have more information between the consumer and central bank can actually harm the welfare. That's what I have. Thank you.
Thank you very much. And let's go straight to the discussion, which will be delivered by Martin Diehl from the Deutsche Bundesbank. Please go ahead, Martin.
Yeah, thanks very much. So I think you can hear me. If you're not, yeah, wonderful. So thanks, Yuchu, for the excellent presentation, and to your co-authors also for this interesting paper. I enjoyed reading it. It is a valuable contribution to a very topical debate we have at the moment. Sorry, jumping too far at the moment. There are many papers written about in academia as well as in policy, a lot of discussions going on, considerations on potential properties of CBDC. And to structure it a bit, some of those considerations relate to interests of the users. For instance, privacy, a lot of papers on privacy. Others relate to interests of the issuer, the central bank. So interest rate or negative interest rate, should CBDC bear interest rate, just for one example. Some of those considerations try to provide special services. One important aspect is programmability. CBDC could be programmable, or offline functionality, of course. And others try to avoid negative implications for financial stability or for monetary policy implementation, though these are those who discuss limits, whether we introduce a limit of the holding of CBDC or whether we imply further use restrictions. Though this is a very important discussion, very topical, because most of the, as you know, most of the large economies, the central banks in the large economies are discussing the possibility to introduce CBDC in the future. The discussion, however, lacks a bit. It lacks mainly the clear objective of central banks. We still, in most central banks, we don't have a clear view what is really the objective of CBDC. Why do we want it? So, and unless we do not know where we want to head, it's hard to discuss any special features because the objective can change the features we need to implement. The discussion also lacks a clear view on the demand of users for retail CBDC, because this is it's not really new. Central bank money is somehow known, but it is so new that most consumers have no clear idea. You know, I've seen papers where they ask a bunch of people about possible features they want to have implemented in CBDC, but half of them had answered at the first question they don't know what CBDC is. So you have to explain it to them and then make them think about what they want. And it is still a moving target, I would say. And the discussion lacks a bit on the understanding of the potential technical feasibilities. What is really feasible from a technical point of view? Now, this paper has proposed, I would say, a very clever idea to introduce an expiry date to enable loss recovery. If we have an offline functionality for CBDC, like it is with cash, then an expiry date may improve welfare because in the case of a loss, it could be recovered. Very clever idea, I think, very simple. It's a partial analysis by means of a theoretical model. And I would say the most interesting result here is the asymmetry of the expiration time around the optimal expiration day, as we have seen as the last picture shown here. Okay, so this is just to highlight to you that there are many motivations, many different motivations for central bank money in very different papers named from central banks. Some are only payment related, others are related to broader objectives. Some are defensive in nature, some try to improve the existing system, and others try to implement new features. This is just to show you there are the many things in discussion, but I still argue, unless we know what is really our main objective, we cannot really discuss how to implement it. So, but let me discuss now this particular idea, the idea best before. First, the relevance. I was a bit surprised. In the paper, in the appendix, you discussed the reliability of the survey you undertook. And I'm not the one to question it, but I mean, it took you, I think, 1 or 2 pages to discuss how reliable the survey is really. I was really surprised about the high numbers. Now, asking to the audience, think about how often do people really lose money? And I'm not talking about $1 or $2. How often do you lose large value money? How often do you lose your smartphone? Or how often is money or a smartphone really stolen? And then again, the whole idea that welfare could improve depends on the occurrence of an outage. how long do outages really occur? Is that really relevant? This is something I really wonder. And so in my eyes, the case that this idea could improve welfare is rather small. Next point, is that the best solution? I mean, isn't it easier just to track a smartphone? I mean, you could track the whereabouts of a smartphone even if it is switched off, unless you take off the battery. You know, as long as there's a battery in it and it has some power, you could track it and find it. So wouldn't that be easier? You could implement the same stuff for other devices. And also for the question of whether it's the best solution, we always have to look at incentive. Don't we give the wrong or the misleading incentive? First, loss recovery entails a significant risk of fraud, as you have mentioned in the paper, and then it is the wrong incentive. I was told as a little boy, don't lose money, you know, and I lose a lot of stuff, but I hardly lose any money because I was told it so often. And if it is too easy to get it back, it's the wrong incentive. Nevertheless, my main point, my main critique, or something which we could think about, it is about the question whether we should create money at all which is programmable. I'm not talking about payments which are programmable. We could money which is used in programmable payment solution. However, should the money itself, the digital unit, be programmable in a way? We have been discussing that. Should it be made dependent on something? Should its value made dependent on something? And here, my personal answer would be no. Don't destroy the trust in central bank money. Central bank money is anyway a very elusive concept. And no, I'm not talking about you and me who deal professionally with money. I'm not talking about those people out there who use crypto token and stable coin and know what decentralized finance is. I'm talking about the people on the street where the money is made for mainly. So we live by the idea that a euro is a euro or a dollar is a dollar everywhere, in every form and in eternity. It should not change. So money is, as I said, an elusive concept, a derived social construction. It is, as you know, the cash is just cotton with some imprint on it. It's a promise by government. And then again, well, governments break their promises rather often, as you know. I'm sorry for that, but it's the case. Most governments are burdened by extremely high debt, and inflation could reduce the debt. So inflation starts to rise at the moment. You know, I'm just picking up what people may think about. And now they issue money with an expiry date. You know what I mean? Most people would not be able to understand really this concept. They would not be able to check it electronically on the device. So my answer would be, don't make money programmable in itself. Make it useful for a programmable solution, but that's another question. Keep the money simple with no hidden features in order to keep the trust in money. So I would argue money would be best without an expiry date. But anyway, the paper is elegantly written, theoretically inspiring, thoughtful paper. Thanks for that.
Great. Thank you very much. I think Martin brought an interesting point about the, sort of the potential of moral hazard, actually. Is that, you know, I don't know, usually if you want to respond to any of the comments made.
Yeah, I can briefly respond to some of it. I think these are all very good points, and it's thought-provoking to look at this. Thank you for the excellent discussion. First, I would want to say that let's not first forget about the survey. We did it on Google, so we think it's somehow relevant because a lot of people might lose their stuff and in a way we cannot imagine. So I try to not to debate with data first, but we can talk about that later. But let's first talk about the solution. Track the whereabouts of the smartphone. So there are two things. First, it's not so clear people would like that idea. it seems like there is a huge debate on privacy. People care about the privacy, and then you track their smartphone, you cannot track where they are. I'm not sure people really like that idea. Second, what we are thinking about is not only the loss event. The loss event is part of it. Another part of it is really phone damages, in which case you cannot open it. In fact, that's part of that survey. So the part of the answer to our survey question is it's a combined of loss event and a damage event altogether. So if you damage your smartphone, in that case, you cannot really reopen it anymore. This would not help that much, I think. And about the central bank money trust, first, yes, I agree. Central bank money needs a lot of trust, and also I want to mention two things. First, what we see as the expiry date is an option. As you see in the app, there is an option there. You can enable it to help you to get loss recovery, but you can choose not to. And in that case, it seems like that does not really harm the trust. And even if you lose a month, you enable the loss recovery option. It's not like if it expires, it's gone. I know there might be some education you need to talk to people because they might think when it expires, it's gone. It's not, right? When it expires and no one claims it, it goes back to your account, but in a different form. Okay. So I agree there would be some education needed. Another thing is, another interpretation of our result is really not the central bank directly provide that. It could be left to the private sector to thinking about that option, right? It could be a private, like a bank or something. Or fintech provide their service based on the central bank digital currency as they start to enable such a feature to their app. What we are trying to say is this app, this feature might be quite useful. You can do it this way. So in that sense, I think the paper can also be used in that way, right? I think my co-author wants to say something.
Yes, go ahead.
Yeah, thank you, you for answering the question for the presentation, but also Martin for the excellent discussion. There were very many interesting points, and I think one of the things that you rightly point out is like, do jurisdictions really want us to issue a CBDC? And I think we also, in some sense, I think part of that, I think we can kind of separate from the discussion of like, if you were to implement it, what should it optimally look like? And I think that second question is particularly important for jurisdictions that have already decided to implement the CBDC. So think, for example, of the Central Bank of the Bahamas. And that kind of also touches upon the point you made about outages. So how relevant are outages really? Of course, like for some things, it's really hard to predict, like what's the likelihood of a cyber attack on the payment system and that being successful and successfully leading to a widespread disruptions. But it's like whether outages are relevant, it's very contextual. For example, in the Bahamas, you would have the hurricane seasons, and I think in general, kind of in many areas in Germany, it would be like much less of an issue in terms of the likelihood, and the same in the Netherlands as well, where I'm currently located. But I think so. That's kind of more kind of in the, like, I think there's heterogeneity across jurisdictions there. But then secondly, like from a modeling point of view, we really centered around outages, but you can also think about this as offline periods. So even if you're in Europe, if you go into the mountains, it might be that you're in areas where you're kind of offline. And of course, then if you still need a way to kind of transact, then an offline payment method can help in case that there's no connection. Also in Canada, there are many remote areas where you actually don't have any cell phone connectivity. And then about the survey and the smartphone and finding back smartphones. you already touched a little bit upon it, but also one thing that we find back in the survey is actually exactly the thing that you point out, is that smartphones, you can actually track them. And that's probably one of the reasons why we find that the probability that people lose funds that would potentially be stored on a smartphone is substantially lower than if these funds were stored on, say, a payment card. So it's like for the payment card, we find a annual probability of around 16%. And for the smartphone, we found approximately 8%. So that seems like substantially lower, and seems also to be related perhaps to the value of the smartphone, perhaps. But kind of that's also what we see back in the data. I was surprised by the level of these numbers as well. But then what we did at the same time is we actually, in the paper, we do robustness checks for the quantitative analysis. So we both look at, say, a 16% probability and an 8% probability to kind of have kind of the full range. And in either case, even if these numbers are on the high side, it is substantially higher than what's currently the opportunity cost of money. And that's all I would like to say. Thank you so much.
Okay, great. Thank you very much. I think we have to move on. I didn't find any more questions in the chat. Thank you very much for the presentation and the discussion. Very interesting indeed. So let's move on. So last but not least, so we have digital currencies and bank competition. Mariam Verdier from Université Paris de Panthéon-Assas. Try to pronounce that. Yeah, please go ahead. The floor is yours.
Thank you very much to the conference organizers for allowing me to present this paper. Can you hear me well? Can you hear me well? Sorry.
Yes.
Yes, okay, thanks. Thanks, perfect. So this is a paper about digital currencies and bank competition. So to introduce briefly the paper, we talked a lot since yesterday about banks as institutions bundling credit to deposit-taking activities such as payments. And we saw in the presentation of Christine yesterday that there are externalities associated to the joint provision of deposits and payments. And Christine talked about informational externalities between deposits and payments. Today, I will talk about another aspect of the complementarity of deposits and payments, that is the management of liquidity by banks. The role of banks is preponderant in payment systems today, both in retail payments and in wholesale payment systems. And in particular, banks have access to central bank liquidity. And this role is increasingly challenged by the digitalization of payments and the entry of non-banks. And in this paper, I will use a standard model of competition between payment instruments derived from the model of Whitesell and connect it to the recent literature on the disruptions of financial intermediation. And the central research question of this literature is whether competition between banks and alternative models of financial intermediation, fintechs, platforms, CBDC for payments, or narrow banks impact lending, payment instrument pricing, monetary policy, and financial stability. So in the paper, I will look at banks competing with a digital currency provider. And there will be some differentiation between banks and the digital currency provider along several dimensions. So the business model of financial intermediation will be different. Banks will take deposits and engage in credit activities, whereas the digital currency provider will not be able to lend to consumers. Second, the characteristic of the payment instruments offered to consumers will be different, also both for the bank and for the digital currency provider, and they will differ from cash. And third, the digital currency provider will offer consumers deposits and payment instruments, which means that there will be competition between money storage and payment instruments. And the research question that I address in this paper is the following: how does competition between banks impact the use of a digital currency as a means of payment. The methodology that I use in this paper is a model of competition between banks and a digital currency provider. And the mechanism of the model is the following. Consumers trade off between payment instruments, cash, transfers of bank deposits, transfer of deposits of digital currency according to the value of the transaction. So they will use cash to pay transactions of small value, digital currency to pay transactions of average value. So the digital currency will compete both with cash and with the transfer of bank deposits. And they will use the transfer of bank deposits for transactions of higher value. And consumer will make this trade-off according to the value of the transaction, the foregone interest rates on deposits, both in bank deposits and digital currency deposits, and the fee for payments transactions. In the paper, banks compete for deposits and consumers may always open a digital currency account at no cost. And when consumers pay from their bank account, banks may incur additional cost of liquidity. So we saw yesterday a presentation relating banks' cost of liquidity to the activity in retail payment systems. So there may be a link between both activities. Banks fund illiquid loans with deposits and choose how much to hold in reserves by anticipating the consumer's payments needs. And in the paper, depending on the intensity of competition between banks, the cost of liquidity will be passed through to consumers through higher transaction fees, deposit fees, and also lending rates. And when consumers pay from their digital currency account, banks save the additional cost of liquidity that they have to incur when consumers make payments from their bank account, but they lose the transaction fees for payments. The results that are obtained in this paper are very simple. I am able to determine the market share of the digital currency in equilibrium of competition according to the design of the digital currency, the interest rate, the transaction fee, the distribution mode of the digital currency, according to the number of banks competing in the market for deposit, according to the cost of liquidity. And I'm able to show if there is a digital currency provider that consumers may use more their bank account to make payments because of competition, since there will be a reduction in the transaction fee for transfers of bank deposits. And I am also able in the paper to analyze the impact of the digital currency on the equilibrium lending rate. And I am able to show that if consumers use more their bank account to make payments, the lending rate increases in equilibrium. However, this may not always happen in equilibrium. Depending on the market parameters, there can be cases in which consumers use more their bank account to make payments or less their bank account. And the results are driven by three assumptions. Banks incur liquidity costs that depends on competition between payment instruments. Their cost of liquidity is not separable in the lending rate and the fee for transfers of bank deposits. And the digital currency and the bank payment instrument compete both as a store of value and as a means of payment. And what I would like to stress in this presentation is that this model can be very general. It's a very simplistic model that can be used to discuss various policy issues regarding the design of central bank digital currencies. In particular, I will stress in the next slide the role of the regulatory framework, which is a key determinant of the adoption of the digital currency. And in the paper, I have to make several assumptions that I am able to discuss in this basics framework. Who is allowed to distribute the digital currency? In the paper, it is a different digital currency provider. It is not a bank. It does not offer lending, but I do not assume in the paper that the digital currency provider is specifically a central bank. The central bank is only present in the paper through the regulation of the fee for digital currency transactions and the interest rate on digital currency accounts. Second, are non-banks and digital currency providers allowed to open an account in the central bank? In the paper, the digital currency provider is allowed to open an account in the central bank with a specific rate on reserves in central bank accounts. However, I have also a discussion in the paper in which I make the alternative assumption the non-bank doesn't have access to a central bank account. Third, another important point in the regulatory framework is whether the digital currency relies on a different unit of account, a token. So in the paper, no. I do not consider full currency competition as in the terminology of Brunner Meyer, Lando, and James. I think this is the main point of the paper is that I model reduced form of monetary reduced competition between reduced competition between monetary instruments. And fourth, does the digital currency account bear interest? In the paper, yes, possibly, but this interest rate may be set to 0 and it may also be negative in the paper. And fifth, is the fee for DC transactions regulated? In the paper, yes, at marginal cost. You will, so let me skip to the next slide. So perhaps I will skip the relationship with the literature. There's a literature on competition between payment instruments. There's a literature on the role of narrow banks and the efficiency of financial intermediation. So in the paper, I do not really address whether this architecture is efficient from an economics perspective. I'm rather interested in the adoption of payment instruments. However, I'm able to explain in the discussion of the paper why it might not be well for maximizing to set a transaction fee for a digital currency payment that is equal to marginal cost. It may not maximize the surplus of depositors. There's also this recent literature on competition between fintechs and banks. So in this paper, the digital currency provider competes on the liability side of banks' balance sheet and not on the asset side. And there is a disruption of banks' management of liquidity. And there is also a literature on central bank digital currency. So the distinctive feature of this model is that this is an IO model. With the cost of liquidity for banks and transaction fees for payment instruments, but I do not analyze financial stability issues. So the model, I will briefly present the model. This is a partial equilibrium model. At date 0, banks choose how to price deposit payments and loans. At date 1, banks collect deposits from the public, keep a share of deposits in reserves. So the amount of reserves in the model will be chosen endogenously. Banks will try to anticipate their consumers' payments needs, and they invest the rest in the lending market. And a consumption shock may occur between date 1 and date 2, and consumers may need to transfer a share of their deposits to another bank. So since I address issues related to liquidity, I have to make various simplifying assumptions. I assume that with some probability, depositors will have to transfer their funds to another bank, and this probability is symmetric, of course. I'm completely aware that in reality, if there are big asymmetries between banks, this could be a problem and this could matter. Also, another point that I would like to stress, I assume that banks charge a fee to the issuer of the transaction, so to the payer of the transaction. However, I heard in one of the previous presentations that it was possible also to charge a fee for receiving payments. So in the model, this would not really change the mechanics of the model as long as banks are symmetric. However, if there are asymmetries between banks, this could change the results that I obtain. And at day 2, loans mature and depositors receive interest rates and pay fees, deposit and transaction fees. So between date 1 and date 2, if consumers transfer a higher share of their deposits than the amount that was forecast by banks with the amount that they chose to keep as reserves, then banks need to incur additional cost of liquidity and transaction costs to adjust their liquidity needs. And so the use of payment instruments may affect banks' liquidity management. So the lending market in this paper is modeled in a very simplistic way. This does not really matter for the mechanics of the model. The only important aspect is that banks are imperfectly competitive in the market for loans. Also, one assumption that can be relaxed, but I make it for simplicity, is that depositors are distinct from borrowers, because here I'm more interested in maturity mismatch between the bank's liabilities and assets. On the deposit market, there are n banks competing as in the Salop model. They are differentiated, and there's a transportation cost TB. So consumers trade off between traveling to a bank branch to open a bank account. And the bank account is a means to store value and to store an exogenous share of deposit D. And consumers open a bank account and split their wealth between their bank deposit account and their digital currency account in share alpha and y minus alpha. The digital currency provider is not located on the cycle because it operates online. And I assume that all depositors open a bank account and a digital currency account. Of course, this assumption can be relaxed, and it's not appropriate for developing countries. In developing countries, the financial inclusion of consumers is also an important issue. And so there will be also some elastic participation to the deposit market. So here there is an elasticity, but the market is covered. So the choice of the bank depends on the linear transportation cost to open an account in a bank, the fixed deposit fee charged by each bank I, and usually those fixed deposit fees are not introduced in the literature on microeconomics of banking. However, the empirical literature shows that banks may react to the cost of payment systems by increasing deposit fees. So I think it's also important to consider those fees. There are interest rates from deposits in a bank account and in the digital currency account. So in the model, the interest rates are exogenous. And there are expected transaction costs incurred by consumers to make payments by transfer of bank deposits or by digital currency. And given the fees chosen by its competitors, each bank I obtains a share of deposits that depends on the fee for deposits, the fee for bank transfer FBI, the fees charged by the competitors, and also the fee for transaction in digital currency. So each consumer obtains a fixed utility of opening a bank account and a digital currency account. There is no cost for opening a digital currency account. And as I explained a little bit in the introduction, consumers will be able to trade off between paying from their bank account and their digital currency account according to the value of the transaction. And if they pay a transaction of, say, size T with their bank account, they will obtain a variable benefit VB, and for their digital currency account, a variable benefit VD. So given the fees charged by banks for bank transfers and the fee for the digital currency, I am able to obtain the market share of each payment instrument. And so this corresponds also to one of the assumptions that was made by Kim in one of the previous presentations. Consumer may use the three payment instruments in equilibrium of the game, but this depends on the parameters of the model. And the trade-off between cash and the digital currency is made also according to the value of the transaction. And the digital currency brings a variable benefit to users, and therefore users will be keen to use the digital currency instead of cash once the transaction value exceeds some threshold that is endogenous in the model. So here are the market share for the payment instruments. So I said banks choose endogenously the amount of reserves to hold, given their expectations of the consumer's payments needs. And there is an expected benefit of liquidity management that depends on the lending rate, the fee FBI for bank transfers, and the fee for digital currency payments. And depending on the consumer's payment needs, banks will either receive the interest rate on reserve too, and if there is a higher transfer of deposits than the reserves, the bank incurs an additional cost of liquidity, which is called rho in the model. So each bank maximizes its profits, the sum of the profits on loans, the profit on deposits, plus the expected net benefit of liquidity management, and the margin per depositor is the sum of the deposit fee less sorry, I don't see it well in the slide, the transaction fees for payments, less the marginal cost for payments transaction, and the bank has to give the interest rate to depositors. The digital currency provider is not allowed to lend to consumer. It obtains, if it keeps its funds in a central bank account, it obtains the interest rate TODI, and there's a regulation of the fee for digital currency payments, and therefore its profit is only the sum of the money storage activity. So here I'm able to derive the choice of the payment instruments. I will perhaps go quickly because I know that there's time constraint to explain how the digital currency impacts banks' competition for deposits and loans. So competition as a means to store value generates a crowding out on deposits, and therefore banks hold a lower amount of reserves in equilibrium. And competition as a means of payments generates ambiguous effects and ambiguous incentives to increase the bank transfer fee. When consumers pay more often from their digital currency accounts, there is one positive effect for banks. They do not have to incur the marginal cost of bank transfer. However, the surplus that they extract from depositors varies. In the model, banks are able to extract surplus from depositors because depositors always open a bank account jointly with the digital currency account. So banks cannot be bypassed completely. This could be due to regulatory reasons, and this happens in some countries, but also to other external, due to other external reasons. For instance, bank accounts may be needed to pay taxes, for instance, or to receive salaries from one's employer. So the thing is that this is one aspect of the effect of the model, but this effect can be also relaxed. Third, the consumer's payment choices impacts banks' marginal cost of liquidity and therefore the interest rate on loan. So in equilibrium, if there is a use of the three payment instruments, I'm able to derive the threshold value of the transaction such that consumers pay by bank transfer, and it depends on the fee FD for digital currency transaction, which is regulated at marginal cost CD, the fee for bank transfers, the cost of liquidity for banks, which depends on, and the benefits, of course, of liquidity for banks, and the interest rate on deposit accounts, because there's also on deposit in digital currency accounts, because there's also competition for money as a store of value. So, if the expected net benefit of liquidity management is not separable in the lending rates and in the fee for bank transfer, then the consumer's decision to pay by bank transfer or by digital currency will affect the interest rate on loan. And this interest rate on loan is given in equilibrium by the sum of a benchmark interest rate reflecting competition between banks and another markup that depends on the additional cost of liquidity generated by the presence of the digital currency for banks. So in the paper, I'm able to compare the benchmark in which banks trade off between, trade off between cash and paying by bank transfer to the situation in which banks compete with the digital currency provider. And I'm able to find that if banks hold a low amount of reserves in equilibrium, the presence of the digital currency may either reduce or increase the use of bank deposit of payment for payments, depending on the marginal cost of each payment instrument, the additional cost of liquidity generated by each payment instrument, and also competition for deposits, which is present through the parameter N, because each bank captures a lower share of deposits when there is a higher number of competitors. And since the share of deposits captured by banks is lower, also the value of the payments made by each consumer is lower in equilibrium. Then I'm able, in the discussion of the paper, to compare what I find here to various alternative assumptions. What happens if, for the adoption of the digital currency, if there is imperfect acceptance by merchants, if there are costs of holding cash, if there is a cost of depositing money in a bank account, linked perhaps to safety considerations and financial stability consideration. And also, I think interestingly, what happens if banks are the distributors of the digital currency? If there is if there is a different account in the central bank for digital currencies, how will it affect the threshold value of the transactions, such that consumers will pay by bank transfer instead of paying by digital currency? And it will be possible in the model to study how the distribution mode impacts the adoption of the digital currency. And one important aspect perhaps that we did not discuss is that also competition during this conference is that competition between banks may affect the rate at which banks pass through the different interest rates earned on reserves, both in digital currency accounts and in traditional accounts to consumers. And therefore, this will affect the adoption of the digital currency in equilibrium. There can be also complete bypass of banks, and also depositors are as borrowers. A fraction of depositors could also borrow from their bank and issue overdraft. But this is not really the essential aspect of the model. I think the contribution of the paper is perhaps to offer a model that enables to compare different designs of digital currencies and how competition between banks and the digital currency provider will affect the adoption of the digital currency with those different designs. Thank you.
Very good. Thank you very much. Let's go straight into the discussion, which will be provided by Jorge Cruz Lopez from Western Ontario University. Please go ahead.
Thank you, Alexei. Can you hear me okay?
Yeah.
Excellent. Okay, so let me just take control of the slides here. Good, seems to work. So, well, first of all, thank you to the organizers for inviting me to discuss this excellent paper. and thank you for to Marianne, because I learned a lot from reading this paper. It is really a very nice paper, and it makes it very hard to discuss, because it's a well polished paper. So I will do my best to break down the model and then provide you a few suggestions. And if I make it to slide number 4, I will be happy. And then after that, I have more refined suggestions that I will be happy to circulate to you, Marianne. So the usual disclaimer applies. I'm also affiliated with FNA. So these are my views and not the views of the places where I'm affiliated. Okay, so I won't try to have an extensive summary of the model. I think Marianne did an excellent job, but I will try to put things into context so that my comments make sense. So the objective of the paper is to develop a model that shows how the issuance of a digital currency by a non-bank operator impacts competition between banks. That's really it. And if I want to be more specific, the question is like, well, how does this competition among banks and a digital currency provider impact the pricing of retail financial services, right? More specific, it's what Marianne shows is a partial equilibrium IO model of competition, where you have this digital currency provider, I'm going to call it a DCP for short, is entering the market, right? They set up payment fees, right? They set up a deposit rate. They're allowed to take deposits, right? And the banks are going to respond by changing their deposit fees, their payment fees, and also their lending rate. That's pretty much what is going on in the model. So it's a very nice model that allows us to see how policy decisions or decisions by these market participants have an effect in the market. But it's also limited in the sense that, well, there's not much that we can do with this model in terms of, for example, assessing monetary policy, right? So just to put things into context. Okay, so this is my mental map of the model, because there's a lot of things going on in the model, right? Like Marianne is laughing because she knows it's true, right? Like there's a lot of moving parts. So I read the initial version of the model last night. Marianne sent me the second version of the model. I went through it and make some refinements to these notes. If I missed something, Marianne, please let me know. But I think that these comments also hold for the newest version of the paper that I received yesterday. So let's start just like the parts of the model. We have the market, we have banks, we have consumers, right? We have the digital currency provider. So the banks and the digital consumer provider are going to be competing for deposits. And then we have a regulatory framework that essentially encapsulates this entire model and creates some restrictions. So let me start first with the market, and you see that I have some parts in red, and this is going to be sort of like the core of my comments. And then after that, I have other slides where I have more refined comments, and then we'll get to them if we have time. If not, I will be happy to give you the slides, and hopefully that improves the paper in the future. So we start with end banks, and one of the things that caught my attention is that there's no real limits to access to liquidity. So as long as you're paying as long as banks are paying the borrowing rate, they can just borrow as much liquidity as possible. So then the results seem like extremely sensitive to that rate. I understand that it's a partial equilibrium model. We want to stay away from like monetary policy consequences and so on, but that seems like a very important part of that drives the results of the entire model. We have one digital currency provider, one DCP. We have consumers that are depositors and entrepreneurs that are borrowers. Very pesky thing when I was reading this is that maybe improving sort of like the language and being consistent with the language will help in terms of communication, because sometimes we talk about consumers, sometimes about depositors, sometimes about entrepreneurs, sometimes about borrowers, and even that was giving me a bit of a headache in like the first read of the paper. So when we're talking about borrowers, there's no credit risk. So that's another. I wouldn't say that this is essential for this version of the paper, but that's a really nice extension, right? It's kind of like the model is calling for it. It's calling for the introduction of credit risk. Why is this important? Well, imagine, for example, first, the transmission between liquidity and credit risk, right? So banks cannot go and borrow unlimited liquidity, and then they cannot complete the payments of their customers. That's an additional cost that can be easily modeled, right? Like this transmission of liquidity, then I cannot return deposits, or I cannot essentially a withdrawal in the money is equivalent to a payment, right? When you do it through a bank. Then you also have like the people that the bank lends money to. We're assuming that everything gets returned at time too. But if that's not the case, and if you want to have a better model of reality, if that's not the case, that's an additional cost and maybe preference for having a digital currency that is kind of like a digital version of cash, if that makes sense. A deposit carries this risk, and this is non-negligible, right? Like we know what happened in Greece, in Cyprus, and so on. So like this is an important component. In terms of banks here are more like sort of like the textbook illustration of a bank, right? They take short-term deposits, they issue loans. There's not really maturity transformation in the model. I just want to be very clear about that because everything matures at time too, right? But it's more sort of like the model sort of like says that just like these loans are illiquid. It's not super clear where the liquidity comes from, but that's there in the model. And I was thinking in terms of maturity transformation. Is there like short-term deposits used to finance liquid loans? Maybe something like that will be better to understand. And the essential mechanism goes as follows. So if a user of the bank, let's say myself, I start making a lot of payments through my bank account, right, in excess of what the bank was expecting, then that drains the deposit account, right? That drains the reserves, right? They have to use more reserves or borrow money, and that increases the liquidity cost. And that's the essential channel that goes through the entire explanation of the model. And I think that highlighting that in the paper, like very early on, will clarify things. And then there's a very important sort of like implicit assumption there, and that's this idea of cross subsidies. The idea that, well, if the bank is reducing transfer fees, right, to be more competitive against the DCP, then in the process of reducing these fees, then they can charge loans more, right? Like they can charge a higher loan rate, and that's when we go to the output part of the model. That's in fact one of the key findings, right, in the model. This impact of digital currency that's the blue box, the second blue box that I have there, and it's on lending rates. And the way that it works through lending rates is through these cross subsidies that are allowed. That might not be allowed in all jurisdictions, right? Like you have to keep some of these things, areas of the bank separate. In terms of customers, we have they have like a set of settlement choices. I will list them there. I won't go through all of them, but it seems to me that there's additional choices. For example, privacy considerations. You mentioned them briefly during your presentation right now, but that to me seems to be like a first order consideration when someone is considering, for example, a substitution between cash and digital currency. That seems to be a first order thing. Perhaps in the model it can be added as a simple cost. I know, Alexei, I have like 2 minutes. So as I said, if I get through this slide, I will be very happy. In terms of like the digital currency provider, right? So you mentioned sort of like 3 variables that are under their control. So the transfer fees, the deposit on interest, right, and the distribution mode. But I think that there's other variables, and this is perhaps an extension or something that can be added there. And I just think like if I set up a DCP, if I'm Facebook, do I really plan to make money out of the transfer fees or selling data? Because that's my business model. My business model is to learn what you're doing, how you're using your wallet, and then selling this data to someone else. And if we are living in this world of cross subsidies, guess what? I'm going to cross subsidize your fees. I'm going to cross subsidize all of this to be able to sell this data. And we see these business models are very robust, right? That's how TVs, the TV market works nowadays, right? You can get this like 60-inch TV for like, under $200 nowadays. And the way that you get it is because, well, it's spying on you and selling your data to marketers, right? So this is I think that a lot of when we're talking about data and collection of data, this becomes like a first order thing. In terms of the regulatory framework, I really like the fact that you really spell out sort of like this is going to be my regulatory framework. That's the area of the paper that I think that the assumptions are very clear. So you're not talking about whether a central bank should issue a digital currency, and that's fine. You clearly explained that that's outside of the scope of the paper. But there's this part where it's just mentioned in the paper that we're just going to assume that the digital currency is the same unit of account as the cash and the deposits. And that to me, I have a hard time, you know, when we're facing like Ethereum and Bitcoin and Libra and all of these things are a different unit of account, and that opens a new channel, right, for competition of store of value, right? Because right now you can see some people are afraid about inflation. Well, see what's happening to Bitcoin, right? Record highs just yesterday. So I think that channel, exploring that channel, will be very fruitful in the paper. So I'm gonna put a ribbon on it and just wrap it up here, because I look at Alex, even though he's like thousands of miles away, he's giving me a look like, come on, man, like it's over. So, but Marianne, this was a very, very nice paper. I have more sort of like minor comments that you can go through them. You can see that it's more sort of like I was writing stuff, and that's for you. One last thing that I will say, you have this thing that I think that is also driving the results of the paper, where I cannot open a digital cash account. I have to go through a bank, have a bank account to open the digital cash account, and that forces banks' existence. We don't need that. I put there like a little news from Bloomberg that shows that you can now go to Walmart in the U.S. in many locations, put cash, get Bitcoin out or like other digital currency. So is there a cash to digital currency? It's very interesting. And I provide a couple to motivate the paper a little bit more in the area of financial inclusiveness and this part that you have in introduction. I included a couple of references that perhaps could help you. Other than that, thank you for sharing the paper. Thank you for sharing the new version. I learned a lot, and thank you to everyone involved in the conference for organizing the conference. I know it's difficult right now with the pandemic, but I think it's been rather excellent. Thank you.
Thank you very much, Jorge. Excellent comments. Before we go to back to Marianne, I think there was a question from the chat, and I'm going to add on to that comment. So there was a question of what would be an example of a digital currency provider in this model. And what I personally actually liked about the terminology used in this paper is that it didn't actually say central bank digital currency, but it said digital currency provider more generally. I think in a lot of papers we see CBDC without anything specific to a central bank. So it could actually be a more general model of a provider. The suggestions were PayPal, Venmo. I suppose these are examples of digital currency providers in the market today. In some markets, they're called e-money providers, especially in Europe. Would you like to respond, Marianne, to some of the comments Jorge made?
Yes, thank you. Thank you very much for the comments. I think I should give more examples in the paper about what I have in mind. Also, one thing that I say in the paper and I have not said today is that the interest rate perhaps is not necessarily interpreted as a monetary interest rate. For instance, for consumers, you can also obtain higher value of keeping, for instance, your money a longer time in your account. Say, for instance, as Georges said before, by keeping your data for a longer time, for instance, in your account. So that could be one way. It's not a literal interpretation of an interest rate. And second, about George's comment about the cost of privacy and the trade-off between cash and the digital currency. So in the paper, there is this cost of making a transaction by digital currency, which is determined in the paper by regulation and completely exogenous. However, we could perfectly imagine that this cost is a cost of a privacy cost for the consumer, for instance. And then we would have also other trade-offs for the consumers according to the marginal cost of the digital currency transaction, but also the cost of giving away some data for each transaction. And so this would also affect the consumer's payments decision. So it can be very flexible. And it is true that I have not oriented the analysis in that way. rather in terms of prices, but the interpretation could be also more flexible than I made it today.
Great.
Thank you.
Excellent. So I think we can wrap it up now. That was the last paper of the last session. Great conference. I think I'll hand it back to Matti now for the closing remarks. Thank you very much.
Okay, thank you, Alexi. And sorry, I will mute my speaker for not to have an echo. And then indeed for the real closing remarks, I will hand it over to Tuomas Välimäki, our member of the board, who will deliver them. So please, Tuomas.
Thank you, Matti. Now it's time for me to close the 10th Economics of Payments conference. We've experienced 3 intensive afternoons, mornings, or evenings, depending on your location, with 23 papers or keynotes. We had 183 registered participants to the conference coming from 35 different countries from all continents. This is indeed a global conference on the themes that are relevant to everybody. No matter whether you are from the financial sector or authorities, a merchant or a consumer that needs to choose the most suitable payment method for your needs. We started the conference with the opening speech of Governor Rehn. He discussed the vision of developing electronic payments from the central bank's perspective. Subsequently, some common themes arose in many of the papers presented. Cash is not disappearing, but its use as a payment method is diminishing as a trend, which has accelerated further with the pandemic. Only 2 outliers were shown to deviate from the common pattern. Namely, in Sweden, not only the transactional use of cash is diminishing, but also the volume of cash in circulation has reduced over time. To the contrary, the market share of cash as a payment instrument has still been growing in Turkey. We learned that especially in times of severe crises and irrespective of their origin, an additional stimulus to cash arises. The motives behind this are likely shifting from transactions towards hoarding. This is something we also need to think when designing the central bank digital currencies. It's intuitive that the use of cash as a medium of exchange fades when the world becomes more and more digital. Yet the authorities probably need to pay attention to ensure that the variety in payment options stays wide enough. We heard how significant amounts of consumer surplus may be lost and supply could become more limited if the payment methods are limited, like the empirics from Uber rides in Mexico illustrate. Yet one should pay attention to potential adverse distributional impact different payment methods may have if their costs are not covered directly, but are mostly reflected in the prices of goods and services. These transfers may relate to non-banked population, as well as to the consumer and merchant acceptance of different payment methods. Regulating the interchange fees the card schemes are allowed to charge could be a way to increase the share of electronic payments. The EU regulation on interchange fees has been shown to significantly contribute to the adoption of electronic payments in the EU countries. Sometimes you don't need regulatory interventions or waiting for long-term trends to materialize to experience rapid changes in the payment landscape. COVID-19 has been a shock that has altered the scheme very quickly. For example, onboarding of new users for electronic payments increased significantly in India as a reaction to the pandemic. Similarly, European consumer preferences at the point of sale were shown to have changed considerably during the pandemic. Going cashless is accelerating, and it seems that the phenomenon is likely to prevail once we are out of the health crisis. The possibility of making contactless payments was shown to have accelerated the shift towards using debit cards on small payments. It is likely that the pandemic has increased the preferences for contactless payments, both by contactless cards as well as with mobile devices. We also saw an interesting illustration based on granular data on the creation of payment networks. Increasing usage brings out more complex patterns from which we may learn on the adoption of the system. On the second day, the emphasis was more on liquidity needs and fintechs. We were presented a pioneering study with a broad cross-border comparison and analysis of the determinants and drivers of the liquidity usage in large value payment systems. The analysis is indeed something for us, the central bankers, to go through thoroughly and to digest when we're contemplating the design of our RTGS systems. On the liquidity needs for transition to instant payments, we learned that more liquidity is needed. However, the increase is eventually likely to be modest. And given the excess liquidity currently prevailing in the systems, this may be an opportune moment to revamp the retail systems. We tend to say that payment system is a critical requirement for modern economy. Yesterday, we were provided with a theoretical setup and empirical data from Russian crisis in 2004 to understand the real economic impact of a payment system panic. We were also presented with a proposal for a framework to assess central counterparties' resiliency based on public disclosure data. Machine learning and AI are entering also the payment systems. We saw an intraday liquidity management game setup with a machine learning twist. In a strategic game setup, reinforcement learning was successfully used for the bank's decision on the amount of liquidity posted. As another topical issue, cryptocurrencies entered the Economics of Payments conference. We learned about the analysis on crypto investors, their motives and their interactions with mainstream finance. It seems that cryptos are not seen as an alternative to fiat currencies, but instead they are a niche digital speculative object. Conclusions suggest how cryptos should be regulated. We were also presented with a framework that can facilitate evaluating what kinds of regulations might be needed with stablecoins. Today, we finally turned to the central bank digital currencies. The keynote presentation explained us how retail CBDCs may come with wide-ranging consequences. The shifts in the balance sheets positions of central banks on one hand, and the banking sector and real economy on the other hand, may result in politicization of central banking. This is something which needs to be taken into account and can be addressed while designing the new form of central bank money. In the more technical sessions, we first were introduced to a demand-side study on the declining use of cash, with a comparison to the developments of the competitors for a potential retail CBDC. Then, based on a structural model of demand for payment instruments, together with survey-based estimates for the consumer preferences, we were shown how the introduction of a retail CBDC could improve consumer welfare, and that for crowding out the old methods, the CBDC would need to be significantly better than the old means. Achieving merchant acceptance is certainly crucial for the entry of a new method into the network business. It's excellent that CBDCs have been given a prominent role in conferences like this. We need a lot of new analysis before we dare to introduce a new type of central bank money. Simply, we, the central banks, cannot operate like startups and innovate with our legal tender. When we are about to introduce a new format for money, we need to be certain that it is safe to use, it fulfills its objectives, and does not come with significant adverse effects. Furthermore, we probably need to start exercising expectation management and to demystify the whole concept. CBDC will not and cannot be a panacea to everything. Currently, there are plenty of different aspects people want to have from it, and some of them are obviously contradictory, like creation of an autonomous payment method by which we should simultaneously prevent money laundering. If and when digital euro comes, it will bring about an easily accessible credit risk-free payment method that offers high level of privacy. We can and will design it so that it will not harm monetary policy transmission, nor will it materially reduce financial stability. Otherwise, we simply wouldn't be introducing one. Finally, let me conclude. The studies presented in this conference can provide valuable insight for development of payment systems and for future policy work. And the work needs to continue. Even if we are exhausted after 3 days of intense presentation, it's good to be reminded that the next Economics of Payments conference is already approaching. We'll be returning to the original rhythm of having conferences on even years. So the 11th Economics of Payments conference will be organized in 2022, and it will be hosted by the Bank of Canada. I want to extend my gratitude to the Bank of Canada people already for contributing remarkably already to the agenda of this conference. So on my behalf, thank you all for participating in this conference. Now back to Matti for the final thanks.
Okay, thank you very much, Tuomas, for the concluding remarks and really summarizing the conference and the content very well. So I have not much to add there. So basically, I just want to say thanks for all the contributions that have made it a great conference. And we will conclude the third day here and close the recording, after which we can continue still informally some discussions.